This video is by far the longest and most thorough Section 8 tutorial slash guide that exists on YouTube. As you guys can tell, it is several hours long and it is a part 1 to 5 combined video that I made because I don't like to gatekeep. I am a Section 8 investor, I'm a licensed realtor. My job is to provide as much value to you as humanly possible, so that way you guys can get into Section 8 investing on your own. So please subscribe and comment down below if this has at all been helpful to you. And I do have a one-on-one mentorship. However, it's not like I'm giving you a PowerPoint and then ghosting you. It is truly a one-on-one mentorship where you're gonna have my personal number. We're gonna be talking pretty much every single day. I'm gonna be helping from beginning to end so that I can help you avoid as many mistakes as possible. We're not gonna hit any $10,000 roofing issues, etc. So if you are interested in that, click the first link in the description, book a free call with my team. Otherwise, click the second link in the description and join my free school community where I have custom modules. You can talk to over 100 fellow investors. And I do a twice a week live Q&A call where you can literally just ask me anything. I like to provide as much free and open, no gatekeeping resources as humanly possible. So if you're interested, click the second link in the description. All right, and now enjoy the several hour-long guide. See you guys at the end. Hello everybody, I'm Joseph Khateri, realtor in the state of Virginia, and welcome to part 1 of my brand new series, Section 8 Investing Masterclass. A step-by-step guide on how to buy cheap properties with as little to no money as possible and get Section 8 tenants inside of there with the government paying you monthly for them. In this series, I'm going to break down every single step needed, no gatekeeping whatsoever. I don't believe in that. This series alone could save you thousands in mistakes. So please, don't just watch this part, watch the whole series. So part 1 is going to be all about picking location. So it's an introduction into location selection. And I want to do as little cuts and edits of this as possible because I want to show you guys the entire thing from beginning to end. So if this seems a little bit long or just not edited fully, it's because I made a previous series where it was all cut up and, edited and fancy. And I felt that it was not as productive as I wanted it to be. It was a little more showy than I wanted. So this whole thing will be minimal edits, just some cuts. And if you see me looking to this direction a few times, it's because my notes are all in here. I'm not going to memorize everything that I need to say. So if you see me glancing, that's why. And I'm also going to be sharing my screen the entire time. Okay, so first off, how do you even pick a city? Well, there are multiple tiers of cities, so I'm going to go through that right now. So there are A tier, B tier, and C tier cities. A tier is you think of a big city and these names pop up, right? There's Miami, New York, Los Angeles, those cities, right? And in general, you should avoid these completely. In fact, most of the time you're going to avoid the entire states that these are in simply because they're too expensive. Now, you can still do this strategy in those areas, but you'll need a lot more money, which I imagine would not be too appealing for most of you. Like, for example, Washington, D.C. comes to mind, right? So let's go ahead and go on Zillow, and I'll show you an example of the type of properties we have in these A-tier areas. So let me go on Zillow. We'll go ahead and just put in DC. So let's clear all of the filters. And we're going to go for, DC is known for their multifamilies and their townhomes. So we'll just do multifamily. Maybe we can find an apartment complex, right? And I mean, you can see right on this right side already, we have some crazy numbers going on. So here's just a good example. It was just one of the first I saw. This is in Washington, D.C. It is 1,500 square feet. I imagine it's a duplex. Yes, renovated duplex. I mean, it looks gorgeous. These are the type of homes you'll see in these A-tier areas, right? I mean, they're gorgeous homes. They're going to appreciate like crazy. But honestly, with interest rates nowadays and, you probably will only put 20% down. I imagine you'll break even on this, maybe make a little bit of money, right? But most of your money is going to come from appreciation. So, you can even see it right here. It looks like this is almost like a flip. It is a flip, sorry. So let's go ahead and see the price history. So, oh man, it's been listed a lot. So 2014, it was sold for 500. And now in 11 years, 10 years, it is close to damn double that, right? 870. So as you can tell, it is going to be a heavy amount of appreciation going on here. Now let me show you what B tier cities are. So B tier cities are cities that you might live in, you might have visited, you can vaguely recall them, right? If you were given a minute or two. But they're still a little expensive, right? So this A tier city, we're looking at like $1 million, right? 800K. So let's look at a B tier city. So like Baltimore, for example. I'm saying that just because I live in Fredericksburg, Virginia. Baltimore is about an hour and a half away. Okay, so let's just look at anything. You have homes that are like this, 625K, and this place looks great, but that's not really a good investment. Like looking at the investment pieces, we'll look for a second. Okay, this looks decent, right? 300K, 4-bed townhouse, 1,500 square feet. It looks beautifully renovated. Some steps right there. But either way, this looks gorgeous, and it's 300K, and this is kind of what you'd find in a B tier city, right? And that's not to say that B tier is bad. If you want some medium appreciation, right? Maybe not as much as DC, but you like appreciation. You don't want like some crazy cheap home that you're scared is going to depreciate or break down or whatever the case is. B tier cities are great. So A tier, I mentioned them, Los Angeles, New York, basically the capitals of places, right? Whereas B tier, I like to imagine is anywhere from like 200K to 500. So Baltimore, Fredericksburg, Virginia, if we're looking in Fredericksburg, I believe average home price is about 430 here. However, you can find some cheaper homes, like this one, for example. That was quick. 350. This one right here, it's a split level home, also 350. It's a 4-bed. Almost all of Texas. So I'm just naming places so that you guys can do some research into them. I'm not saying you should 100% invest in these places. I'm actually licensed, so I can't fully just say that as a realtor, but I can as a consultant in my course. So some other examples are, oh man, I'm blanking. Yeah, most of Texas, Baltimore, someplace in upstate New York, and a lot of the Midwest, if I'm being honest. So yeah, Richmond, Virginia. Now let's go ahead and look at a C tier city. So these are cities that I'll say them and you'll go, oh yeah, I guess that place exists, right? Maybe you don't want to live there. I'm sorry if you do, and I'm offending you. Maybe you don't want to live there. Maybe you're only there for work. But either way, they have jobs, they have a population. Yeah. So some examples, and maybe this is where all of you start dialing in. Birmingham, Alabama, some other place in Alabama, most of Mississippi. They rent for a lot less in that area, though. Keep that in mind. I'll teach you how to do rents later on in the video. Detroit, Michigan, Cleveland, Ohio, Toledo, Ohio. Don't look at Akron. I know that a lot of gurus say Akron. That place is flooded with investors, right? If you're going there, expect to be paying like 200K. St. Louis, Missouri. And there are some more places, but I just don't feel comfortable mentioning or recommending them. And the reason is because, there's somewhere like Memphis, Tennessee, where homes are under 100, but for a reason, right? It has the highest murders in the entire world. There's other places, like there are some in Virginia that are under 100, right? But I imagine it's 1 in 20 square miles. So it's not possible to buy it and then scale. You also want to make sure you pick a place that you imagine staying for at least 5 to 10 years or keeping your investments there for 5 to 10 years at a minimum. And there's a few reasons for that. The first is that if you end up using a DSCR loan, these types of loans typically have a 54321 prepayment penalty, which basically means that you can Google it. But first year, if you sell the house within 12 months of buying, you have a 5% penalty on your loan price, and then 4, 3, 2, 1 for each consecutive year after. So in order to sell it, penalty free, and granted, these aren't big penalties, you want to keep it for 5 years. Or you can just pay the penalty, or, I could do some digging and try to find a lender that won't do a 5, 4, 3, 2, 1, but most do, or else they wouldn't go so low in home prices. So yeah, you want to make sure that you keep the homes in there for at least 5 years on average. And it's just good for scaling. You don't want to be bouncing place to place. It makes managing a lot harder. So the next thing I wanted to talk about is HUD rental rate basics. So FMRs. And I'll read some definitions on this side. The HUD's fair market rent is the baseline for what Section 8 will pay depending on bedroom count. So I always recommend you find a place that has a 2-bed or a 3-bed that is going for at least $1,200. Just because, that's not a hard and fast rule, but I've just noticed if you can get that 1,200 marker, that's typically an okay sign that it's worth it to keep looking in the area. So yeah, and let me show you how to do that. So we'll go ahead and look at somewhere like Cleveland. Again, I'm not saying just invest in Cleveland, right? I'm saying do your own research, and this is just one of the areas. Oh man, I'm sorry. I'm going to keep jumping from topic to topic a lot, but it's just coming up as I remember them. How do you find a lot of these cities? Like maybe you can't think of cities, or maybe you're just bad at geography. Maybe you're not from the US. You can definitely still do this as an investor, and I'll talk about how. Hint, hint, you need 35% down payment if you're a non-citizen. So it's still possible as a non-citizen, just a little bit more down payment. But let's assume you are one of those people. Okay, so how do you find these cities that I mentioned previously if you aren't familiar with US geography? Well, you can use this website called InvestorLift. You can make a new account. It's free, at least to make the account, it's free. And we're going to go ahead and just explore this website. So it'll bring up a map of the US, and you can put in the price that you're looking at. So let's say you're looking at up to 200,000. And it can give you kind of a hotspot locator. So as we see like 500 here, 114 here, 246 here, 291 down here. So we can zoom in and zoom in again, and we can kind of see what the hotspots are in red and orange. So I do see down here a red spot, 155. That is Houston, Texas. So then you can go back on Zillow and you can type in Houston, Texas. And now you can browse the homes, right? I see a beautiful, oh my God, look at this place. That's a castle. My Lord. Anyway, sorry. Here's a 3-bed for $215. This is kind of what we were saying for Texas. Here's another 3-bed, nice place for $196. So this is good for finding cities, but if I'm being honest, do not look at properties on here, right? Because it just feels scammy. I've never fully used this, right? So maybe I'm talking out of my ass here. But it doesn't feel right to use this. Like, it's sketchy. That's a good way to put it. So first off, you have to request the address to even do anything with it, but that by itself is weird because they're just scraping your data for sure. That's what they're doing it for. Or, it'll say 117, right? I'm sure this house is on Zillow somewhere, but win it now for 127. Clearly, they're pocketing the 10K, right? At least I'm assuming. Sorry, this is all assumption. And the only way to connect with them is by using their lender and their realtors and whoever. I don't like that. It seems sketchy. So I use it to find cities, but once I know the city, I just go on Zillow. Where was I? Yes, FMRs. So we'll go ahead and look at Texas once again. We'll look at this house right here. 4202 Oates Street, Houston, Texas. So let's say that you found a city and now you want to figure out what FMRs can go for, right? So we'll scroll all the way down and we'll find the county that it's in. Texas, Harris County, and it is 77020. You're going to go on Google and you're going to just type in HUD, FMR, and then the year. And typically the first thing is what you need. It's a .gov website. Scroll down, click here. And then you're going to go to Texas. I already forgot which area that was. Harris County. Okay, zip code 77020. Right there. So, a 3-bed is $1,450. And that is not as good as I was hoping. But I kind of figured it was just a random example. But that is how you find the HUD rates. And you might be wondering, oh, but Joseph, is this, so you're telling me if I list it on Zillow, this is how much the government will pay me? No. A lot of people get that wrong, and maybe I didn't explain it well enough originally. This number is simply the maximum the government will give you for this property, right? That is all it means. It is not how much you can rent it for. It is not a guarantee. Right? It is simply the government saying, hey, we'll give you up to this amount. That is all it's saying. So if you discover, right, let's go on, we can even see what does Zillow estimate. So it estimates you can actually rent it for $1,743. If you list it as $1,743, the government will only give up to $1,450. And that is if you're paying utilities. This $1,450 number includes a utility voucher, which I can also show you that as well. The way it works, and there's actually a calculation, I believe on the previous page, but that $1,450 payment, it'll actually be like $1,300 is the government rent portion, and the other $150 is a water voucher, electricity voucher, gas voucher, that make up it. Right, so I don't know exactly where this Houston one is, just because I picked it as a random example. But off the top of my head, I know the Cleveland Housing Authority, I know where that one is. So if we go to cmha.net, right here, and I'm just doing this to show you as an example, the rent section, where is it? Right here, utility allowance chart. So this is a very good example to what I'm talking about. So a 3-bed, right? Right here. So this website might say, a 3-bed gives $1,468, right? You can see, for example, if you are paying for the trash, you'll get, if you don't pay the trash and you put on the tenant, $9 will be subtracted because they're assuming, once again, this $1,450 or $1,468 figure on this website is if you're paying the utilities, right? So another example is right here. If you have natural gas and you're making the tenant pay it, that is $62 gone, etc. Now you're probably asking, okay, Joseph, so now that we've realized that that number on this website is only what they can give you, right? What should I actually list the home for? I could list, even though this says, let's say 2,000 right here, I could list it for 3K, 4K, 5K, any number I want, really. However, the government will only pay up to 2, and the tenant has to pay the rest, right? So you kind of just treat it as any other rental. Find what the surrounding homes are renting for and just go based off that, right? So let's just look at Cleveland, just because that's what I'm most familiar with. We're going to look at this first home. I barely looked. A little rough, kind of looks, whatever. We'll use it as an example. So, perfect. Currently rented to Section 8 tenant who has been there for 4 years. All utilities are paid by the tenant. It is $950 a month that they are getting. And that way, tenant is paying all utilities. And in fact, I think That's probably a little bit low as to what it should be, but that is just an example, right? For all I know, all the homes on this street are also renting for about $1,000 for Section 8. So even though the website I was just showing you said like $1,450, that is only the maximum. That is not what you actually can rent it for. The reverse is true as well. So we'll go ahead and look at something like the affordablehousing.com. This is kind of like Zillow, but for only Section 8. So we'll look at this exact zip code, 44108. Cleveland. All right, so 3-bed, 1,400 square feet, single family. So we'll only look at 3 beds. And we'll only look at single family residences. And we'll see what they're renting for. So we're seeing... this is a good example. 44108, 3-bed, about the same square footage, and it is going for 1,300. And it says it's a waiting list, meaning it already got applicants. Let's see, paid by tenant. Oh, they're saying, okay, all of these have to be paid by the tenant. However, the owner pays the water, sewer, trash. So it seems to be about 50-50 for the utilities. Yeah, I can't tell exactly where or when it was listed for, but I'm sure if you call the agent, you'd be able to just directly ask to see what the average list times are for this type of home. But it seemed like, okay, 1,300 was fair with about 50-50 split on utilities for that type of square footage. So again, it is not what you see on the government website. That is just how much they're willing to pay at a maximum. So if you see people listing it for 1,100, 1,200, guess what? If you put it for 14 because you think that's what the government website will give you, you're not getting a single applicant. And you might think, oh, why not? They're Section 8. Well, guess what? They still typically pay a portion of the rent. Maybe it's not the whole amount, right? But maybe it's still 10%, 20%. And with somebody only making $800 a month, 10 or 20%, that is a big difference. To you and me, it might be $50. To them, it might be a week's worth of their salary. Okay, so now that I kind of told you how to find the locations and how to figure out what you could actually rent it for reasonably using affordablehousing.com, now it's time for the next step, which is you want to actually look into the cities themselves, right? You want to do some background research on them. So we can go ahead and look at this site that I like using, city-data.com. And you can go really specific with this website. So we were in the zip code 44108. And we can look at all of the details. So 52% renters. It looks like in 2000, the population was 36K. In 2010, it dipped down quite a bit. 25K, and it's estimated now we're at about 20K. So this seems like a declining area. What else can we see? It is predominantly black, as well as the second is white. So 88% black area. The estimated house value is 68K. With the average being 220. So if we're being honest, this is a fairly poor area. I'm just being blunt here. That's what I'm seeing. So it's up to you if you'd like to invest in an area like this. If I'm being honest, all I ever the population is a bit concerning, but what I look at most is I like to keep things simple, right? Can I get a good deal on a house? That's number one. And number two, can I rent the house at the price that I want to make my numbers work? And number three, can I do it for probably at least 5 years? That's all I really care about, if I'm being honest. Because if I can do that, then I can reliably rent it for at least like 5 years. And if I don't like it after the 5-year marker, I can do a 1031 exchange, which is when you almost trade the house for a different one in order to avoid paying capital gains tax. So, I mean, I like to keep things simple, right? I don't like to overthink these things because it'll cause analysis paralysis. I mean, maybe you don't want to choose the zip code specifically. But, that's kind of my point here. That as long as it works for you, that's really what matters. So if we choose somewhere else, like let's say 44103, there's a 76K house here. How is 44103 doing? Let's check. All right, 44103, 73% black. Second place is white. Again, home price is pretty low, 63K average. And where is the population? That's what I was looking for. Oh, sorry, right here. So this is actually doing kind of the same, if we're being honest. So the populations are dipping in this area. So that's something you want to keep an eye out. We'll go ahead and look at maybe this one, 44111. And this is a better one. If I'm being honest, it stayed pretty consistent. It's only gone down a pretty minuscule amount. In fact, it's almost the exact same from 2010. So I'd argue this hasn't gone down at all. Granted, this was a more expensive area. So that's kind of the point that we're seeing here, right? It's mostly white. Go figure, right? Okay, average home price here is 143. So I'm going too much into this, right? But my point is this website is great for looking at the details of all these areas, right? And again, all I really care about, again, in my opinion, I'm looking at this as an investor, right? All I care about is, can I rent this at the price I want for at least, 5 years, maybe 10, right? And you have to keep in mind that once you find a good Section 8 tenant, they very rarely leave. I mean, you saw the listing earlier. That tenant was there for 4 or 5 years. That they typically stay for long stretches of time once they find a place that suits their needs and isn't run by a slumlord. Before you start investing in these areas, you also want to make sure of the actual housing authority rules and regulations. So you can pretty easily find this. So let's say Fredericksburg, Virginia, right? I can just Google rental laws and boom, what's this first link? Ta-da! A full 41-page document of all the laws and regulations for landlords. And I believe, where does it say? Yeah, so it just gives every rule possible, basically. And the reason that the reason I'm even saying this is because some places will require special certifications or certificates, whatever the case is. For example, Cleveland being one of them, you need a lead paint certification. And I actually didn't know this until we got a house in Cleveland, an investment, and we ended up getting it and realizing it needed a lead paint certification only after we finished the rehab that took like 2 months. And guess what? The city said lead paint certifications take 60 to 90 days. So we messed up there, right? We wouldn't have messed up if we just called the housing authority beforehand, or even just Googled the landlord laws. So here is another place we can see tenant and landlord resources. Okay, that site's not loading for some odd reason. That's pretty weird. Whatever that is. But that's my point, where you want to do your research and even just call the housing authority and say, hey, I'm thinking of investing in the area. Could you pretty please tell me if there's any weird laws or anything? I'm not from the area that I need to be aware of. And they could help you out there. You can also call them and ask about the wait list. So you can say, hey, how long is the wait list? Do you guys have a huge influx of landlords? Like, do you have too many landlords in this area already? Or do you have not enough tenants? You could say, how long is the tenant wait list? Is there even a wait list open? And if they're saying, oh yeah, if you're a tenant and you apply, we'll get you a voucher in 2 weeks, then that is a very bad sign. That clearly means there's too many landlords. And the opposite could be true. They could say, oh, if you're a tenant, you can't even apply. we have so many people on the wait list. We desperately need landlords in order to get them more housing. That could also be true, and that is a good sign, right? Supply and demand. So now we want to make sure of inventory levels. And this is something that I see so many people guilty of that they mess up, and it infuriates me because, look, if I'm being honest, a lot of it's common sense, like at the end of the day. So let's take, what's a good example? Houston, Texas. I'm just going back to my previous examples. Let's say that you only have the budget for a house that is $100,000, right? Which is fine. That is a lot of people's budgets. We'll put a maximum of $100K, and you want it to be at least a 3-bed, let's say at least a 2-bed, right? And you want it to be a house. Multifamilies are good. However, I don't recommend it for Section 8. And the reason is because I don't typically like having Section 8 tenants share a wall, if I'm being honest. It's just kind of a headache. Plus, multifamilies rent for less, so a lot of the time it's the same returns for more headache. Each unit will rent for $600 instead of just renting a full house for $12. So I like multifamilies, but I recommend regular tenants for those. Or a lot of the times, if you have a low income or you want a house hack, they're fantastic for that. I wish I had a multifamily here in Fredericksburg to buy, but they don't exist really here. Because what a lot of people do is they use something like a 5% down payment loan to get a multifamily house. And then they'll live in one unit and rent out the rest. And I think that's fantastic. And it is what I recommend to a lot of my clients as well if you are low on cash. Anyways, we're looking at houses only up to 100K. And would you look at that? Only 28 results. Now you might think, hooray, 28 results. I can buy up to 28 homes in that area. No, you can't. 28 homes, especially this scattered, right, is going to cause a huge headache for your realtor because they're going to have to run from one area to another all across the city. But second, these homes are being bought by all cash buyers or corporations who, again, are basically all cash buyers. Like, you can even see, look at this home. 14,000 views. 14,000. And it was like posted 17 hours ago or something like that. That's crazy. So clearly you are not getting this house. Like, I'm sorry, you're not. Like, we'll even look at the newest homes. So this one's 75K and 9 hours ago and 175 views already and probably 6 saves because it'll be 6 showings and it's 9 hours ago. Like, you are not getting these homes. I'm sorry. Like, I know that's a buzzkill and I know I'm being a negative Nancy, but you are wasting your own time and the realtor's time if you're trying to go for homes in this low of an inventory area. Now, you might think, okay, so what do you think is the criteria to find these? Like, what do you think the home prices are in this area? Well, I like to look at least 80 results. 80 that you could close your eyes and pick any of them, right? So, if you're set on Houston, right? Let's up the price to 150. Oh, now we have 172 results. So guess what? That passes the 80 I was talking about. So that means if you're wanting to buy in Houston, Texas, chances are you're going to be hitting up to 150K, right? Like, for example, this would be a good Section 8 house right here. It's 130, right? So expect to be buying between 100 and 150 if you're going for Houston. Another example, let's do Fredericksburg, where I live. We'll start off at 100. Guess what? Nothing. Up until 150. 1 result. That's not enough. 200. 2 results. That's not enough. 250. 3 results. That's not enough. How about 300? 5 results. That's not enough. 350. Okay. We're getting somewhere. 18 results. Again, that seems like a lot, but it isn't. You're going to be beaten out here. So we'll consider 350 the baseline. Now let's see. 400? 37 results. So even that doesn't have that many homes. Let's increase it once again. 450. There we go. Now we're looking at 64. Now, granted, Fredericksburg is a much smaller area. I believe you have a population of like 20 to 30,000 people. So incomparable to something like Houston. So I would say in smaller areas, you're looking at 50 results. So we are seeing, 50 results. That would probably be somewhere between 350 and 450K. That'd be your purchase price here. All right. And kind of a funny trick that I like to do. It's called, I didn't come up with it. It's called the Starbucks rule. You want to see how close the home is to a Starbucks, because Starbucks likes to invest in higher appreciation areas. That's where they like to put their stores. Let's say you're interested in this home. I showed it earlier. 350K, 6,000 Oak Grove Drive. Let's go ahead and pull up Google Maps. And the closest Starbucks is 6 minutes away. That's a good sign. So if it's under 10, that's usually an okay sign. Again, this is not some random hard and fast rule. It's basically made up. I just am noticing a common trend is all. And what's probably a better indication of a strong rental is the distance it is from places like factories, hospitals, companies, etc. All right, so I also wanted to give a piece of advice, which is higher inventory means less bidding wars, and that is always a good thing, right? It's going to make the process so much easier. Now, if you want to get into these bidding wars, you can, but I don't recommend doing them until you have leverage, right? If you're doing a 3% down payment, 5%, 20%, you're going to lose almost every time. So, and I always recommend a home inspection. You shouldn't ever waive your right to one. So you can do bidding wars if you already have some properties under your belt, or okay losing the bidding wars, and preferably are all cash. Then you can do the dogfighting. And if you're also worried about investing in really poor neighborhoods, not poor by income, but just bad choice neighborhoods, or like D-tier neighborhoods that you probably shouldn't even be stepping foot in, ask the realtor that I refer you to, because I will be referring you to a realtor throughout this process. Especially if you join the Section 8 Mastery program I have, you'll have access to all of my connections. But if you end up getting with the realtor, they know the local area. Like, directly ask them, hey, is this an okay area to even be buying in? And they will just directly flat out tell you. Like, yes, their job is to sell you a home, right? But I interview my agents and they have repertoire with me. They're not going to give a bad recommendation, because then I'm going to stop using them. So rest assured, you can generally trust them. And once again, cheap does not always mean good, right? That's what the home inspection is for. That's what your realtor is for, to give you guidance, as well as me if you end up joining my mastery program. Cheap does not always mean good. Just because a home is listed for $60,000 does not mean it's the deal of a lifetime, right? You wanna make sure why it's a cheap price, right? Maybe it has water damage, fire damage. Maybe it's in a really bad area. You should go on Google Maps and, we'll do this home as an example. Go on Google Maps and just look at the street view. And there's the home. So let's look at this area. How is it? I like to say, would you meet someone on Facebook Marketplace at 9 p.m. here? Or maybe you don't want to meet someone on Facebook. Would you go on a jog or a walk at 9 p.m. in this area? And if I'm being honest, I mean, there's a main road right here, which is like slightly annoying, but this area seems fine. I mean, it's a single family area, the cars are relatively clean, right? They're maybe not like brand new, but they're clean, which is nice. Streets are cracked, but not major potholes, no overgrown weeds on every step, right? So I would approve. I mean, come on, that looks pretty. So once again, and I'm going to read off my list here. A-tier cities, high budget, high appreciation. Los Angeles, Austin, New York, DC, lower cash flow, and sometimes break even, depending on interest rates. Higher home prices, stable home prices, and highest appreciation possible. B-tier cities, medium budget, right, like Baltimore. medium appreciation. So Baltimore, Chicago, New Orleans, Richmond, most of Texas. So medium cash flow. Maybe you'll match the stock market. Medium home prices. Usually stable home prices unless there's some type of economical recession. And just average appreciation, right? We're talking 5%, whatever the case is. And then there's C-tier cities, which I imagine most of you will go for. Low budget and low to sometimes no appreciation. So Cleveland, Detroit, St. Louis, Birmingham, Jackson, Toledo, like I mentioned earlier. High cash flow, low home prices, variable home prices, right? So it might dip, it might go up. That's kind of just part of the risk. And I usually say I don't bet on appreciation. You know, I'll look at an average of maybe 3, which I believe is below average. But I'm not a betting man. I'm not a gambling man. A lot of the time I'll just say, as long as the home price stays the same, I'll be happy, right? Maybe if it raises a tiny bit just to cover realtor fees when selling. But honestly, as long as it stays the same, that's what I care about. And again, this is a cash flow strategy that I'm talking about. It's not an appreciation strategy. If you want an appreciation strategy, that's great, but look at B tier cities or A tier cities. All right, now, the next thing we're going to talk about, forming an LLC. Disclaimer, I'm not a CPA. I'm not a tax professional. I'm not an attorney. I am just a dude who has done this before and is going to show you what I do. So that is just all I'm advising you on. So, why do you even need an LLC? That's a question I get a lot. The reason is because it protects your assets, right? So, and that's a big reason why, as well as tax benefits and all that. But I imagine the main reason most of you will want it is just because of asset protection. So, let's say I don't have an LLC and I just buy a home in my personal name and I get a tenant in there. If the tenant slips on the sidewalk and breaks their leg and sues me in court, they can sue me and, claim my car. They can claim this house that I own, my personal home. They can go after my bank account. They can go after my stocks, right? But if the home is owned under an LLC, then they can only go under the LLC's assets, which typically is just the home itself. Meaning my car can't be touched, this personal home can't be touched. Usually only the rental itself can be touched. So, but you need to set it up properly, as well as make sure you aren't doing anything that can pierce the veil of your LLC. So there's a lot of different reasons you should get an LLC. Property repairs, you can write them off. Mortgage interest can be written off. And also, you can use them for DSCR loans, which I will cover in a little bit. So how do you set up an LLC? It's pretty easy. So I'll do it for Virginia just because I'm used to it. So I like to just Google the state, Virginia LLC registration. And I actually have a separate YouTube video on this. So click the first link. It's a .gov website. Perfect. Start a new business. Form a new Virginia LLC, 100 buckaroos. So file online. You're going to create an account. I'm just going to log in with mine. All right. So now that I'm on the website, I can go to online services, new businesses. I am filing a limited liability company. Do you have a name reserved? No. And we're just going to make one up. How about we do... Oh, and you ready? Here, I'll give you a little tidbit right here. This is something that I stupidly didn't realize a few years ago when I was making my first one of these. We'll do Khateri rentals. Yay. So if you check the availability, it'll say, you'll see, not allowed or name unavailable. Now you might think, why would that be possible? Does someone have this exact name? No, it's because I didn't put the word LLC at the end. And I didn't realize this a few years ago, and I spent like 20 minutes on it. There we go, name available. We'll click next. You can typically, I like making a new separate Gmail for everything related to your business for this rental. So put in Khateri Rentals, yay, lc@gmail.com. This is fake. Okay, perfect. And this will be just under general, perpetual, and registered agent. So if you are filing for the same state as yourself, you typically, if you're filing an LLC in the same state that you are in, which, by the way, sorry, I should have said this earlier, you should file an LLC in the state you want to buy in, right? So if I want to buy in Ohio, I should make an Ohio LLC as a foreign entity. If I want to buy in Virginia, I should make a Virginia LLC. So if I live in Virginia, I have a Virginia accountant, and I want to buy a house in Virginia, I typically can put myself as a registered agent, or you can ask your CPA to put them down as a registered agent. However, the reason you cannot do this for out of state, so let's say I want to make an Ohio one, I can't put myself because the registered agent has to have a legal address in the same state. And that is a problem because you don't live there. So how do you go over this? Well, if your accountant is in that state, fantastic. You can try to put them down. Or you can just Google the state registered agent. And the first 10 results are just going to be places that do it for $50 a year, and you can just list their address. All right, so we'll just put myself down because I can. All right, now that we've gone to the next step, you're going to put your principal office address, basically the address you want to use for this. And I believe this one does not have to be in Virginia, if I remember correctly. But if I am wrong on that, I apologize, and it might be best to get a P.O. box in the area you want to buy in. So I'm putting just a fake address right now. Okay, management structure, manager managed. I always skip the supporting documentation, and then you simply sign it right here, review it, add it to your cart, and then pay. And that's about all you have to do. Then in your email, you're going to get a few documents. You're going to get the articles of organization as well as a receipt. And you're also going to want to need an EIN at this point. So now you can just Google EIN. I think it's EIN sign up, maybe? There we go. Okay, good enough. Get an EIN. So the IRS has an online website you can fill out. I believe it's only available, which is weird that it's only available during business hours. You'd think this is an online bot. Don't know why it can't be active during business, during any hour, but it is almost 11 p.m., so it's not working. However, if this website is working, then it basically just asks you please insert your LLC information, such as principal office address, owner of LLC, etc., as well as I think your social. And then it will simply get you an EIN emailed to you. So, hooray, fantastic. And that's about all you would need. And if for some reason it still doesn't let you, it gives you some type of error, what you'll have to do is you'll have to submit an SS4 form, and you'll have to submit it. I believe there is you can't email it. You have to actually fax it in typically, or mail this form in. It takes multiple weeks. It's very annoying. Yeah, you go to this website for instructions. I've had to do this one time, and it took weeks. It's very annoying. The online bot is so much nicer if it's working. All right, everybody, let's take a break right here. I've been recording for an hour, 6 minutes. I wanted to talk about the Section 8 Mastery course that I just opened. So it is a mentorship program, and the reason I made it, even though I have been in the past kind of opposed to making courses, the reason is because I saw all of these gurus with their Ferraris and such, basically spouting incorrect info and selling dreams, right? Marketing tactics in order to get people to sign up for their 7K course, right? Where they were giving inaccurate figures or giving strategies that simply don't really work for beginner investors or people with low capital. So I wanted to make a actual mastery program and a mentorship program that worked for a beginner, right? That wasn't scammy. I'm not selling you a dream with 40% ROI. No, I'm not doing that. You'll even see in our sales calls that we say very realistic stuff. So I wanted to say, here's what you'll get, and please listen in because you'll see the reason why it's not really just a course. So we'll help you find the best markets, pass the HUD inspection, scaling from 1 property to 10. And here's the important parts. You can DM me at any time, right? And also join a community of fellow investors. So that's pretty cool. You can directly just DM me and talk to me and I'll help you with your issues. There's also weekly group coaching sessions. So every week we all hop in a call and I lead it. I'll answer Q&A, I'll find deals live, etc. And you can book one-on-one coaching sessions if those group ones aren't enough for you, like for free, as long as you're in the program. So I think that's pretty cool. I don't think many other gurus are doing like direct one-on-one time because they'd rather just give you a PowerPoint and then leave you to dry. But I'm not doing that. And I think that the price is easily justified because you get these one-on-one coaching sessions, group sessions, and if I can help you save, or if I can help you even avoid one mistake, then you'll make up the cost immediately. For example, if I help you avoid a roofing mistake, boom, 10K saved right there. So I view it as an investment and a way that I can personally help you go through this process. So if you're interested, click the link in the description, and you're going to want to do this fast because I only have a limited number of slots. Because again, I am helping everyone one-on-one. I only have so much time that I can give. So now we're going to talk about financing. And I'll talk about some vocab that I'm going to use. So gross monthly rent means the total monthly rent you expect the property to generate. No expenses or anything, just $1,400, something like that, right? I'm also going to talk about NOI, which is rent minus operating expenses. So it's minus taxes, minus insurance, maintenance, management fees, etc. Cash flow, which is the income left after mortgage payments. And this is the part that I think the gurus try to scam you. They'll say, oh my God, my property is generating 700 in cash flow. That doesn't mean 700 net. That means the 1,400 gross minus just like the mortgage payment. And nothing else. And I think that's kind of scammy and misleading. Realistically, we're going to get you like $350, $400 after net, which again is still a great return, but it's not 7. So those are what we're going to talk about. Oh, and if I just refer to just net, it's the same thing as net operating income. Okay, so how do I do my calculations? I do it 2 ways. So I like to keep things simple. I think analysis paralysis is very real and affects a lot of people. So I just literally Google rental property calculator and boom, I click the first one. And this is what I use if I'm being honest. I know. You guys might be like, oh my God, why is it so simple? It's because I like it that way. I don't want some weird complications going on. So if you want something more complex, then I use this app called dealcheck.io. Again, it's not beginner friendly. I think it honestly gives too much details that confuse a lot of people. But if you know what you're doing, then this could be a great resource. I have an affiliate link. It's going to be down below. It's right here. Dealcheck.io !FP_REF equals Joseph81. And it'll be linked below. You can just like type in the address and it'll automatically pull in a bunch of info from public records. That is such a blurry image. There you go. That's a good example of kind of how it looks like, the UI. Okay, so now we're going to talk about the 1%, 1.5, and 2% rules and what they are and why I follow them. So 2% rule simply means you can rent it for 2% of the purchase price. So if you buy a home for 100K, you want to aim for 2,000 in monthly rent. However, you can only typically hit this with a BRRRR strategy: buy, renovate, rent, refinance, repeat. It's very hard to hit with just like a turnkey property. The 1.5% rule, I think, is probably the benchmark most of you will use for turnkey properties or close to it, where you're not doing some crazy rehabbing. Again, it's the same thing, just you can rent it for 1.5% of the purchase price. So if you buy a home for 100, you can rent it for 1,500. Or the 1% rule, which I think is more for like B tier and A tier cities, where you're also going to get some appreciation. So yeah. And I have in my notes, show comps. I already showed you how to do comps. You go on affordable housing in order to figure out what you could realistically rent for. I showed you utility allowances. Sorry, I'm just going down this list here. Okay, yes. So strategies for the utilities. You have 3 options. Number 1, pay utilities yourself. You most likely will get the most amount of money possible from the government. However, there is a downside, which means the tenant could end up spiking usage, right? They fill up their pool with a hose, then suddenly your water bill is $800. Downside to this, that's the downside. Upside is that there won't be liens against the property. So if the tenant doesn't pay their water bill for enough time, the water company or government can actually put a lien against your property. And that means basically when you go to sell the property, they get paid first. The unpaid bills get paid first before you get a cent. And that sucks because guess what? They weren't originally your bills. They're the tenant's bills. But suddenly now you're paying for them, right? Option 2 is have tenants pay. You'll get less from the government. That's kind of the main thing with this one. You'll get less from the government, and the problem is liens can happen, right? If the tenants pay and decide not to pay the water bill, then guess what? A lien can happen. Whereas if you pay utilities yourself, you won't get liens because you're paying the utilities. Or you could do a hybrid approach, which I like, but you have to ask the housing authority if it's possible. Some areas will let you, some won't. Where you basically say, hey, can you give me the voucher for example, the water voucher, $50 water voucher? Can you give it to me directly, not to the tenants? And then can I write into the lease that I will only cover up to the voucher limit? So I can write in there in the lease, landlord will only cover the $50 allotted water voucher that HUD provides, something like that. And anything above will be paid by the tenant. So you have to check with the local realtor as well as the housing authority if you can do that. But if you can, that's the best bet. Because guess what? If they no longer, let's say it's a $60 bill and you can only cover $50, that $10 you have to collect from the tenant. If they owe you that money and never pay, now you have grounds for eviction. So you can evict them in that case. Whereas if they don't give that $10 to the water company, then guess what? The water company is just going to put a lien on your house and you're going to have to pay it. Sorry about that. My phone died. I didn't even notice. All right. So now I'm going to go over some key variables as to what is going to hit your cash flow the most. Mortgage payment, which is based on your down payment and interest rate. Taxes and insurance. Maintenance and reserves. And then property management. So maintenance and reserves, I like to put in like 10% monthly of the gross rent. And property management is typically 8 to 12% of the gross rent. So now I'm going to do an actual case study on this. I'm actually going to literally do an example live to show you guys that I actually do this and know what I'm talking about. So we'll go ahead and look at, just because I like picking different areas, we're going to look at Detroit. So we're gonna look at 100K. Oh, I want to mention something that I forgot. Sorry, I keep bouncing around. There are not that many homes under 100K. Across the entire US, I think there's about 1,500, give or take. Out of those 15, how much need rehab? How much were in fires and aren't really fixable? Probably a lot. So my point is, there's probably going to be more than 1,500 people that view this video, hopefully. So what does that kind of mean? Well, that means some of you will have to dogfight, right? And you're not going to be able to be, pretending that, or not pretending, you're not going to be able to do these like, oh, let me lowball them, right? No, that's not a thing with homes under 100. Like, unless it's a home nobody wants, in which case you probably shouldn't go for it either. Like, for example, this 80K home right here in Detroit, chances are you're going to have to pay full price and even compete with some people for this home. Because guess what? 80 homes under 100 just aren't that common. They aren't. I'm sorry. They're not. They just aren't that common. And I wish they were more common, but they're not. So you can't realistically say that you're going to, I'll offer 65. I'll offer 75. No, you're going to offer 80. And you're not going to waste my realtor's time. You're not going to waste your own time. You got to say your expectations correct, right? If this home was clearly overpriced and the realtor is saying so, right? Like, let's say this was 250 and it's probably only actually worth 200, then yeah, you could offer like 200 and go with the realtor's recommendation. But if the realtor is like, yeah, you got to do full price, then guess what? You're doing full price, okay? So I want to point that out. I got a lot of people who I refer to my realtors, and my realtors are like, yeah, so I'm showing them 90K homes and they're offering 85, 80. And we've put in 10 offers and I know they're not getting accepted any because they're lowballing. Like, we're in a full price market. So don't send me this lead again. So I'm begging, just be aware of what you're getting into. All right. So anyways, I'm sorry. I went on a tangent there. So let's look at, I'm on the newest of this, so at least 2 beds, and we'll look at only single families. So we're going to go ahead and do some calculations live. We'll say, I'm just trying to find one that I like. How's this one? Oh, okay. This one looks good, right? Maybe needs some light rehab. I'm not going to lie. You know, it looks like the cabinets need a little work done. The floors look okay. They do look a little scratched up. I'd definitely make sure the realtor takes a good look at the flooring. But let's just try this one out, right? And it also doesn't have a garage, which is nice. I don't like garages because almost always the tenant just fills it with garbage and it becomes like a hoarder situation. So let's go ahead and see, what zip code is this? What area? Michigan, Wayne County. Okay. So we'll go on the HUD website. Michigan. Wayne County. This is a, what was this? 3-bed? 2-bed. And zip code is 48205. I've been recording in a while. I'm losing my voice. A 2-bed will go for $1,250, right? Yes, that is a 2-bed. So $1,250, and we'll go ahead and keep that in mind. So purchase price $75. 20% down payment, we'll say an 8% interest rate. Closing cost is around 7 on average. We'll say you put 10K into rehab, so now it's worth $85,000. Perfect. And scroll down, we can see the monthly payment section, and we're looking for taxes. So it'll say $1,170 a year. By the way, these are estimates. If you want the actual 100% correct value, you can go on the public records page for this county. I'm not doing that because I'm fine with estimates. So it is saying taxes is $1,170. Insurance, I'll say $800. Just because, again, just based on like averages, that is what I typically see. Maintenance, we're going to go with 10% of the rent. So we'll actually leave this blank because we don't know what we can rent it at, as well as other costs for now. So monthly rent. Now let's figure this out. We know the government will pay a maximum of $1,250, but let's see what we can actually reasonably rent it at. So we'll go to this zip code on affordable housing. By the way, here's actually a nice thing that I forgot to mention. If you go to the owners tab and market rent estimator, you can just type in the address. And honestly, it's fairly accurate. There we go. Morang Ave, Detroit. Yes, 2-bed. I like to pick the lowest value out of these. Okay, so it's looking like about 1,000. That seems fine. So we'll go search for homes, 48205. Yes, okay. 48205. And now we're going to go ahead and see what 2 beds go for. Property type is a single family. 1,000. Okay, so it's looking like $1,000. And let's see. Everything's paid by tenant on this one. What about this other one I just saw? Which actually has a wait list, meaning it already has applications. Oh, did I miss it? Did I just scroll past it? All paid by tenant. Okay. So $1,000 and there's no payment by the landlord. Okay, so maintenance, we'll say $100 a month. That's 10%. All right, let's calculate. Oh, I'm sorry. And let's say you hire management at 10% as well, which is average. Vacancy rate, we'll put 5. And it's because that is on average what I'm seeing. It might take like a month or two to rent, but then that tenant might stay 3 to 5 years. So it averages to be 5. Oh, wait, whoops. Did I miss one? Oh, whoops. 0. Okay. So this seems like a pretty normal return. And I like to see it. So yes, this number definitely seems low, but I don't like looking at this number because it's honestly kind of misleading. And again, it's why I don't like the cash flow. I like the ROI, and we're getting a 15.71 return for ROI, which is fantastic. The stock market averages 9. So we're beating it by a pretty wide margin here. That is a solid rental. Yes, again, it says 242 for the cash flow after, everything. But again, it's just not that, what's it called? Oh yeah, you're only putting in $32K, which sounds like a lot, but again, for rentals, that's not that bad, right? Because if you want to buy like a $400K house, right, 20% down will be $80,000. So $32K in order to get about $250 a month, that's fantastic in my opinion. And again, I'm sure that if I did some more digging, I looked for 20 seconds through the Zillow link, I'm sure I could find some other homes that, rent for like $1,300, for example. I mean, I even saw when we were looking at Cleveland. So let's say I could rent it for, the $1,250 I saw. Then yeah, we're looking at like $450 then. So again, for me looking for 15, 20 seconds, I think I did, I found a pretty good property, 15% ROI. So I'm happy with that. Okay. And now time for pretty much the last section, which is the actual loans itself. And I've been yapping a long time. I am tired, so I'm sorry if my voice doesn't have it in me anymore. Let me go ahead and I actually have like a cheat sheet for this that I'm going to provide. I'm going to put it on screen just so that I can kind of show you and you can visually see what I'm talking about. For most loans, there's a minimum purchase price of $75K. That's just how it is. Anything lower is typically bought with cash, like I mentioned, or you're doing a burst strategy, which means you're doing private money at first. I have private money lenders, by the way. But if you're going DSCR, yeah, typically it's $75K. Or conventional, even most conventional is $75K. So here is kind of the weird checklist I have. I'm very like type A. If you have over 700 credit, at least 27K in cash, a good debt to income ratio, have a steady income according to your 2 years tax returns, then you're going to probably go for a conventional 20% down payment loan. Keep in mind for this one, you cannot use an LLC typically. A lot of the time, if you want to go conventional or FHA, they'll ask for 2 years of tax returns for the LLC, which you typically don't have because you just made it. So if you're going conventional, just keep in mind you usually can't use an LLC to close. You usually have to wait for something called a title seasoning period to end, which they'll just tell you how long that is. So it could be, 6 months, a year, never. You just have to ask the lender. All right, so second, if you have 660 credit, 27K in cash again, at least 6 months of cash reserves, you don't want your income checked, you want to use an LLC, and you're okay with a little bit higher interest rate, usually 1.5% higher than what's on the market, then we're looking at DSCR loans. 80% of you will end up doing DSCR loans. I have a guy who does DSCR loans in almost every state. Just FYI. I'm saying because it helps me, it helps my network, it helps you because you're using a trusted person. If you need a DSCR loan, right, just join my mastery program. You'll get access to the guy, all right? You're not going to have to go digging around for anybody. So just saying. And this next point is for non-US citizens. You can still invest. It'll require 35% down payment though, and typically a 100K purchase price. So they're not going to check income. You can use a new LLC once again. The main difference is simply the 35% down and 100K purchase price. Next, if you have pretty much no cash, but at least a 580 credit score, 650 is preferred, but 580 is the minimum. Not much cash at all. You haven't bought a house in the last 3 years. And this is the important part. You're okay with living in at least one of the units for a year. And you have at least a steady income. It doesn't have to be a huge income, but it's just steady. Then you can get an FHA loan at 3.5% down payment. Or if you want to buy a multifamily home, you can get a 5% down payment loan. Again, you have to live there for 1 year, at least in one of the units. So, but this method is going to be the lowest amount of money possible. All right. Now, if you have 700 credit, but you also don't have much cash at all. So the main difference here is the credit scores. You haven't bought a house in 3 years. You're okay with at least living in one of the units for a year, have a steady income. Then you'll be doing a conventional 3% down payment. So again, the main difference is the credit score, but I like the conventional 3% more because with FHA loans, you need PMI, which is private mortgage insurance. And typically it's a little bit higher with FHA loans. And the only way to get rid of it is a refinance. With conventional 3%, you can get rid of it at any point as long as you have 20% equity. So I prefer conventional 3%, but you do need a better credit score. All right, and finally, if you have a 620 credit score, a large amount of cash, super high risk tolerance, it's the riskiest strategy. You've done rehabs in the past, you're familiar with construction, and you're okay with basically having the home become a part-time job, and you want to scale as fast as possible, you're looking at private money into a refinance loan. So it's a BRRRR strategy, and I have a video on that. So it's buy, renovate, rent, refinance, repeat. So you're going to buy a house that's cheap, 50K, whatever, using private money. You're going to put, let's say, 20K of rehab into it. So it's now 70K you're into it. But then the bank appraises it at 110, just because you did such a good job rehabbing. And now the normal appraisal value is 110. Now you can refinance using a conventional or DSCR loan, keeping in 20% equity, taking out 80%, and that 80% will pay off the private money, make up your rehab costs, and give you a little nest egg for the next property. That's the fastest scaling, heavy risk. Okay, so I'm recording this while I'm editing the video because I realized I forgot to mention a pretty important part, which is once you pick one of the loans that you want to do or however you want to finance, then, join the course and I will hook you up with those lenders. I will get you in contact and get you to fill out an application with whatever lender you need. So if it's conventional or DSCR or FHA, join the course and I will get you those contacts, get you those applications you need. And then once you fill out the application, which I'll guide you through as well, you're going to get a pre-approval letter. And then you're ready for the next step. So once you have the pre-approval or the secured financing, then we're ready. I don't know why I forgot to mention that. All right, and now let's go over creative financing. There is a few methods. All cash. It's not creative, but it is the strongest offer and less headache. There is seller financing. As you can see, do not recommend this. It is simply too difficult to find a seller financing deal in this market. I 100% think that. And I feel so bad that people are still watching my video from like 2-3 years ago and where I do recommend seller financing. It just does not work anymore. Seller financing, people have kind of become wise to it and they know that it's just not a good deal, right? Because seller financing in this market, it is on the seller's terms. So if you ever find a seller financing deal, first off, most people will think they're a scam, so they won't even offer it. They won't even pay you any attention. But second, even if they are willing to think about seller financing, it's going to be on their terms. 12% interest, a 10-year loan instead of a 30-year loan, right? These people are 70 years old. They're not going to want a 30-year loan with you. So it's just not recommended, and I can't recommend it in good faith. All right, and another creative financing option is partnering with people. You can do this in my Section 8 mentoring program. You can find people to partner with. Or if you don't like partners, which is totally fair, I don't really like partners. You might know a doctor friend in real life who has a chunk of money, but they're too busy to invest personally. You could partner up with family, etc. I firmly believe like 80% of you will end up just doing a DSCR 20% down payment so that you can use an LLC. So I believe that covers most of you. Some of you with lower cash might end up doing an FHA or multifamily or conventional, and that's okay. But I think most will fall into this DSCR 20%. And I don't like partners, if I'm being honest. You guys can, but I honestly think that most of what you need is just some mentoring. So, moi. Anyways, I have a headache. I'm like a little bit dizzy. I've been recording for almost 2 hours now. Oh my Lord. My phone has died like twice. I had to feed my cat. I'm tired. I'm ending this video here. By now you should know how to pick the right market, make an LLC, how to pick the right area, how to do the calculations, how to figure out what rents you can rent it at, and what kind of financing is best for you. So just one last time, if you are interested in one-on-one mentoring, click the link in the description, join my new mastery program. I can only accept a limited number of people. And if you're looking for DSCR lenders, or conventional lenders, etc., realtors, join my mastery program because I give those completely for free in there. And I vet everyone. So I think that's it. Wait for part 2. Hopefully that'll come out in a week. Hello everybody, I'm Joseph Khateri and welcome to part 2 of my series on how to buy and rent Section 8 properties. Now we're moving on to one of the more critical steps, and that means by the end of this video, you're going to exactly learn how to hunt for an actual house. A lot of people mess this stuff up by picking the wrong property, crunching the wrong numbers, and it ends up ruining their deal as well as their whole Section 8 experience. So by the end of this video, you'll know how to find the right property, You're going to know how to connect with a realtor. You're also going to know how to vet your numbers and your deals properly so that you can prepare for an offer. And stick around until the end of the video because I'm also going to go over how to access my personal entire network of realtors and contractors to make this process even easier. All right, now let's get to it. First things first, get a realtor. And I know, you can search for one on Zillow, you can search for one on Redfin, realtor.com. You're going to be recommended plenty of them. Your uncle's neighbor's sister's brother is a realtor. But let me make this clear. Going with them is a mistake. When you're dealing with Section 8 rentals specifically, as well as just investment properties, you need a realtor who knows the local market and works with investors and understands what Section 8 inspectors look for and what Section 8 even is. I can confidently say that I work with a lot of realtors. I am a realtor in Virginia, and so many of my coworkers don't even really know what Section 8 is, and that's quite alarming. But to be fair, the average realtor doesn't deal with investments. The average realtor deals with getting your mom and pop their first time home or trying to find a home with more land. That's not what this is. A good investment realtor will find deals that you won't see on public sites. They're going to know which areas work best for investments and Section 8. They're going to know how to run comps as well as get rental estimates for you right off the fly. They're going to know what prices you're going to need to enter at as well as negotiate for you, usually saving you tens of thousands of dollars, which also means that their entire point is to negotiate better prices for you and handle the legality paperwork. This is not realistic for a first-time investor to do themselves, and it's also not realistic for your mom's brother's uncle's sister who has a realtor license to do themselves either. This is something you need a specialty realtor for. But how do you find one of these golden egg realtors? Well, I personally have a list of vetted realtors that I interview myself all across the country. And these are realtors and contacts that I exclusively give to my Section 8 Mastery program. So if you want access to my Section 8 mentoring, then go ahead and click the link in the description. You'll get access to my personal list of vetted realtors and contacts in order to progress smoothly with your first transaction. So click the link in the description. So now I want to show you guys a real example of where a realtor might benefit here. So this is a real listing that a student of mine and I were contemplating putting an offer on. However, we ended up not putting an offer on this because of what the realtor told us. So we see based on this Zillow listing, it's $77,900, fantastic price, 3-bed, 1,550 square feet. And we'll even look at the pictures here. It looks fantastic, and the interior is pretty much turnkey, ready to go. There was some light flooring discoloration, but other than that, it is gorgeous. We were ready to put an offer on this home. We were. However, when we told the realtor about this, they said, hold yourself, I need to tell you something. They first off told us that the property is rented at $850 a month, which is public information, it's listed right here. But then they dug into what their current lease is. They found out the lease lasts for multiple more years, and we potentially would be dealing with a monster tenant if we tried to kick them out. So let's say that there was 3 years remaining on their lease, and we ended up trying to raise the rents to what would be comparable, which is around $1,250 for this house, or even just ask them to leave at the end of their lease. We could be dealing with a squatter situation. They also stated that the location of this home was not ideal. And again, we wouldn't know that because we're not in Birmingham. This local realtor is, and they saved us from potentially buying a bad deal. Once you have a realtor, it's time for the next step. Step 2, tell your realtor your criteria. So now that you have a realtor, it is your job as an investor to tell them exactly what you are looking for. So that way you're not spending hours just filtering through Zillow. Instead, they're going to just email you a daily list of properties that fit your specific criteria. So here are some things that you're going to have to tell your realtor. Number 1 is price range. What price do you want to go in at? Most of the time, most people in this strategy are going for between $50K and $150K, or really whatever works in your budget. I mean, as long as most of the houses you're looking at are fitting the 1% rule or 1.5% rule, then the budget doesn't matter as much. It all honestly depends on how much cash you have. But I assume most of you watching are going for cheaper homes, so probably sub 150. And a pro tip that you might remember from the last part of this series is that most types of investor loans and conventional have a minimum purchase price of $75,000. So you might want to tell that to the realtor. You also want to make sure that the homes you're looking at are at least 2 bedrooms, because more bedrooms equals more that HUD tends to pay you. And you also want to tell them the general condition of the homes that you're looking for. Now, most realtors aren't able to really filter out by condition that well, so they'll end up sending you a mix of everything. but at least the realtor would be able to pinpoint some of them and give you rough estimates as to what the rehab would be. So for example, if you're looking to BRRRR a house, for example, buy, renovate, rent, refinance, repeat, then you're looking for homes that definitely are distressed on the cheaper end. So maybe you are looking at 50K. You're going to tell the realtor, hey, I'm looking to do a BRRRR. They're going to know what you're talking about. Or you can just say, I'm looking for distressed properties that I can rehab and potentially get it appraised at a way higher value. Or you could do the opposite. You could say, I'm looking for something that pretty much needs zero rehab. I'm new at this. I don't want to deal with contractors. Just get me something ready to go. You're also going to want to tell them the rent potential. So you want to be able to tell them specific zip codes you're interested in. Or if you don't really know that, you can just say the entire city is fine, but you will want to request that any homes that you're interested in, you ask for rental comps of it. You want to ask for both what a regular tenant could pay for this property, as well as what a HUD tenant could pay. Those are two different values. Admittedly, a lot of the time they're very similar, but Section 8 tends to pay just a little bit more. And you want to also ask about neighborhood quality. So when you're looking at these types of homes, it differs so much street by street. In these areas, you'll have homes that are 200K in pristine quality. Everyone signed up for the country club on one street, and then literally walking 100 feet to the right, you'll see something that is equivalent to an apocalypse movie. You don't know what these places are because you don't live there, most likely. Your realtor will. So just directly ask them, say, is this a D-class neighborhood, a C-class neighborhood? What type of neighborhood is this? Because you're aiming ideally for a C-class. That is right in the sweet spot. The appreciation won't be crazy. In fact, you might not get appreciation, but they're not drug den areas and you won't depreciate. Once your realtor has this criteria you're looking for, as well as you provided them with a pre-approval letter, then they'll start sending you properties. They're most likely going to put you on some type of daily email blast. And also, you can continue looking on Zillow too, because 90% of the properties will be the same. I just like going off of the realtor's website because you have the ability to typically heart or thumbs down the properties they send and they can see it directly in their portal. So here is an example of a email that was automatically sent out to one of my own clients. This is a real email to a client, but as you can see, it was viewed at 2:55 p.m. It was sent automatically at 6 a.m. and it says 3 new updated and 1 sent. So it looks like in this email, it ended up sending the 2 coming soons and 2 actives that they're interested in the Fredericksburg area. And if we go ahead and click on any of these homes, you can directly see that it was auto-emailed this morning at 6 a.m. No idea when this is going to get uploaded. But it'll look something like this, where it'll say all of the expected information. Okay, so at this point in the process, you should have been able to connect with a realtor, hopefully through my Section 8 mentoring program, link in the description. The realtor should be sending you properties based on certain criteria that you asked for. And now we're going to go to step 3, which is crunching the numbers on these homes you're being sent. And this is where a lot of investors mess up. They'll just assume a property is profitable because it's cheap. Wrong. In fact, I'll even just use this one as an example again. Yes, it is cheap. It's pretty much the minimum for a loan to get approved. Yes, it does have a pretty good interior, as we can see. But if you're going to end up doing, let's say, a DSCR loan at an 8% interest rate, and home insurance on rentals tends to be, let's say, $800, then you're looking, even Zillow's saying $562 in mortgage payments, PIMI, which is fine. That's pretty low. But then you factor in that it's only being rented at $850. Well, suddenly now you're making, $300 in cash flow? That's not enough to cover any type of maintenance or repairs. If this was $1,250, then I would say, yes, this is a fantastic house and you should go for it. But there's just not enough wiggle room here. So you want to use this formula before moving forward with any type of house. Step 1 is look at the HUD rental rate for the specific area of the home you're interested in. Step 2 is using a rental property calculator to plug in expenses. And then step 3 is ensuring that you're hitting at least a 12 to 20% ROI. Now, I like to make sure it's at least hitting 15. That way, if you end up making a few mistakes here and there, which all investors do, you're still hitting maybe 12%, which is above the stock market. As you get better at investing, your ROI slowly goes up. Okay, so now before moving forward, I'm gonna go through some of the common links and websites that I use in order to do my calculations, just so that you can all have it pulled up if you're doing things alongside with me. So first, I like to just use Zillow. Of course, you could just use the Realtor's MLS system, but obviously I am not getting emails from a realtor right now, so I'm just using Zillow. Then I like to have the HUD 2025 FMRs pulled up, so you can go ahead and look at the description because I'll put a link here, or you can Google HUD space FMR space 2020, whatever year it is, and you'll end up clicking this site, so I'll keep this handy. I like to have this rental property calculator for any quick calculations, so it is my go-to. I typically use calculator.net just to see if an area is worth investing for. However, when I'm actually looking at the homes and comparing them side by side, 123 Main Street versus 456 Main Street, and really crunching the numbers and keeping things organized, then I use dealcheck.io. Here is my referral link. It is also going to be in the description. It is dealcheck.io FP_REF equals Joseph81. So we'll go ahead and go through it. And I'm just going to sign in because I already have an account, of course. So as you guys can see, it is very easy to organize all of your rental properties, and we're going to go ahead and actually add one to this list. I like to also have city-data.com in order to look up zip codes and look up stuff like statistics, crime rates. I like to use spotcrime.com in order to look up specific streets and the crime in that area. And then finally, I know a lot of different sites and such, but I swear they all have a purpose. I like to use affordablehousing.com, going under the owners tab and clicking market rent estimator, as well as just the regular affordable housing homepage. Yes, affordable housing twice, but there's a reason and I will get into it. Before we move on, if you are serious about investing in Section 8 rentals, I just launched my Section 8 Mastery course that I mentioned earlier. Inside of the program, you'll get my personal network of vetted contractors, lenders, and realtors. You'll also get a step-by-step on how to pass the Section 8 inspections, exact rental property templates, as well as analyzing deals with you. You'll get template leases, you'll get guides, how-tos, and over 33 videos in our course. But most of all, and I think this is really where the value comes in, is I work with you one-on-one. This isn't me just giving you a PowerPoint and then ditching you. I work with you one-on-one no matter what stage in the process you are. For example, I'm helping someone form their LLC tonight, and at the same time, I'm helping another student actively put in offers as well as crunching the numbers. So yes, it is all one-on-one. I'm personally helping you, and I'm going to help you from start to finish. So if this is something you're interested in, go ahead and click the link in the description. It is the first link, and set up a free strategy call with a member of my team. I hope to see you in my program. Okay, so now let's go through an actual example. I'm gonna do it live too, so you guys know I'm not messing with you. So I've been doing Birmingham a lot recently, and I'm not saying it's because you should definitely invest in Birmingham. I'm really doing it just for, honestly, ease of factor. I even mentioned in the last video that I probably listed like 7 or 8 different places you can invest, like St. Louis, Detroit, Cleveland, Birmingham's one of them, Toledo. So I'm not specifically saying Birmingham's the best. In fact, it's pretty average, I would say. I'm mainly doing it, again, just because it's already on my homepage. So let's go through some of these. All right, this one is 75,000, 1,200 square feet. That sounds interesting. Let's look at it. Okay. Decent exterior. I'm not mad at it. Not a fan of the interior. I mean, it's okay. It's just okay. 75,000, you know what? I'd probably put in an offer on this one, just going off of my gut feeling, but let's read the description. Okay, investors. Currently rented at $675 to a long-term tenant on a month-to-month lease. That's a red flag. Now, I normally don't mind tenant occupancy. I don't. However, I just have a not great feeling about this one, mainly because it's a long-term tenant. So that means that they might kick up a fuss if you try to either increase the amount of rent or simply kick them out because it's month to month. They're gonna make a fuss about it, and they might end up in a squatter scenario. I'm not too comfortable with that, especially when there are other viable choices. Okay, so this one says $80,000 and a price cut of $5K just a few days ago. 3-bed, 1,200 square feet. Let's look at this one. It says that it's a perfect investment opportunity. It is occupied at $950 a month. However, it doesn't say anything about it being a long-term tenant, which is nice. And they're even saying that there's room for updating and increasing rents, which implies that, that they are open to it. So let's go ahead and look at some of this. So the home itself looks, I'm not a huge fan of that bowing right there, but we'll keep looking. Let's go ahead and see the rest of it. Just needs some, honestly, some pruning, really. Get a good gardener in there. It looks like the actual home itself is decent. Good flooring, good paint. I don't see much wrong with this. Okay, so now let's just say that this is a potential property. And again, I really only looked for a few, maybe 45 seconds there, 60 seconds. I'm sure that there's better ones out there, but once you scale to a certain number, you kind of stop being as picky. So let's assume that this is a viable choice first. So first thing I'm going to do is I'm going to look up the zip code, 35228. Alabama, this is in, what county is this? Jefferson, 35228. I believe they go by zip code. Let's see. They do. So I'm going to do Control F, 35228, and it seems like a 3-bed will go for $1,440 maximum. So that's good. If I'm being honest, I don't think this would rent for $1,440, but it is good to know that the government at least has that leeway, because if they said something like $1,000, I wouldn't even be able to consider this property. $1,440 on the government side. Perfect. Now I can take that out of my mind. Let's continue looking. So the next thing I'm going to do is I'm going to go on citydata.com as well as spot crime, because there's no point in buying a house if it is in a terrible neighborhood. So what I like to do is Zillow has an option for Street View. You can also go ahead and just go on Google Maps and type in the address. But let's look at the street. So this is the home. Ugh, it's like a weird mint green. I don't like that, but whatever. And we're going to go ahead and look at the neighborhood. So I like to look at two main factors here. Number one, if it was 9 p.m. at night, would I be comfortable going on a jog by myself? I'm a guy, so maybe as a woman, I probably wouldn't want to do it no matter the location. But at least in my case, I'm asking, at 9 p.m. at night, would I be comfortable jogging or doing like a Facebook Marketplace deal here? So let's go ahead and look at the area. The second thing I look for, and I'm saying this before we started looking, is I look for boarded up windows and trash on the ground, as well as the condition of cars. So if I see boarded up windows, even on the same street, no, it doesn't matter. I don't care if it's 7 houses down. If it's on the same street, it is a no. Trash and cars, that you kind of have to play it by ear, but we'll do a live example, like I said. So this is the house. It's fine. Ooh, I don't like the neighbor. You see, the problem is I don't know how many of these cars are for this house and how many are for that house. That's a little concerning. I'm not going to lie. I'd probably ask about that. If these are all the neighbors' cars, I would definitely ask if that neighbor is still there or not, because that is ridiculous. All right, let's keep looking. The streets themselves look fine thus far. The homes look fine. They're a little bit cheaper, but nothing wrong with that, right? Some weeds here and there. I think this definitely looks like a lower income type of area, but if I'm being honest, it's not that bad. Okay, so going down the street, I still don't really see boarded up windows. I do see some broken blinds. Yeah, some vegetation there. Let's keep looking. The cars are in... Okay, so this house seems decent again. The cars are in decent condition. There's nothing crazy going on with that. Uh-oh, is that boarded windows? I can't tell. That might be boarded windows. Wait, let's look at the front door of this one. Come on, show me the front door. Yes, okay, there we go. Boarded up house, that is a no-go. We're done looking at this property. Okay, so here is another $80,000, 107 71st Street, North Birmingham, 3-bed, 1,100 square feet. It says it's move-in ready, but come on, we'll judge that for ourselves. Okay, we'll go ahead and look at the pictures. It does look really nice. I do like this. Looks gorgeous, a nice cheap but solid remodel. You can always tell because they use everything's not like super there's continuity. So as you can see, there's like tile on half of this and then it goes into a gray paint. So it's just a cheap rehab, but that's fine, really. They use the same gray paint on the walls. Okay, and it looks like that kitchen is tiny. You might need to put in a fridge here. Oh, you can even see the tile is kind of like those stick-on tiles, which is, again, fine. You might need a fridge here as well as a stove in order to pass the Section 8 inspection. You don't technically need a stove, but you need a stove hookup, and I provide the stove anyways. Now let's do the exact same thing we just did. Let's go to the street view. All right, looking on the street view, this is the house. Immediately see some garbage, not a great sign. Oh, but this does seem to be in a place with a lot of businesses. Businesses are always good. I like that. There's a church right here, a playground. Okay, let's keep looking. Okay, the cars look fine. This neighborhood looks pretty neat. There's businesses in the area. It's not awful. And there looks to be a very big park here. So I think this one's fine. Next up, we're going to go ahead and look at spot crime. I want to make sure that there is no crazy like deaths, killings, murders, violent crime in this specific street. All right, so we are on 107 71st Street, which is right this one going down. Seems like there's some stuff a few streets over, but I think that's far enough away that it doesn't matter as much. Seems like there's some shootings in the general area, but again, they don't seem to be on the exact street. And I think a big factor is just the fact that it's so close to a church and a school. People probably are a little bit nicer in that area. Now we'll look up the zip code. It is 35206. Okay, so we are seeing a lower population, but that's pretty normal if I'm being honest. I don't think you're ever really going to find anywhere with a population that's increasing because the entire US population is decreasing. So as long as it wasn't a drastic drop, it seems like it took 23 years to just go down 5,000. I think that's fine. So I want to find the median home price. Where is it? Okay, right there. $136,000. We're going after a home that is 80. So that's a good sign. All right, so now let's go ahead and see what the actual fair market rent would be. So first thing I do is copy the entire address and I'll put it into this affordable housing market rent estimator just to get a rough guideline as to what I'm expecting. So it looks like, okay, I'm expecting between 1,100 and 1,250-ish, it seems like. But now let's confirm it, 35206. So now I'll go into affordable housing's main site. You see, I am using every single one. 35206. And you want to put in the same number of bedrooms that you have, the same type of property, single family. How many results? 47. All right, so we have a 3-bed at 1,100 square feet and it is turnkey. So now let's try to find comps of that. All right, here it seems to be a comp. It looks to be a pretty similar home. How's the interior? I think our interior is a little bit better than this. I'm not gonna lie. Okay, how is this one? This one's roughly the same square footage. Okay, this has a very nice interior. I like this one. I think this would be a solid comp to use. It is 3 beds, almost the same square footage, and it is at $1,200. And it seems like all utilities are paid by the tenants. Again, for the utilities, I like to do a hybrid model. However, you can just make them all paid by the tenants. I think that is a little bit risky because liens could eventually happen if the tenant does not pay. So I like to do a hybrid approach where I write into the lease that I will pay the utilities up to the voucher limit. So for example, if the HUD voucher for water is $60, I'll pay $60 and then the tenant will cover the rest. But whatever, that's not the point of this. The point is in our calculations, it'll be paid by the tenant and we'll put it for $1,200. So you can use a calculator like this. This is what I'm used to using, if I'm being honest. We can go ahead and put in all of our calculations here. A purchase price of $80,000 with an 8% interest rate and $7,000 in closing costs, which are just the average that I'm seeing in the market at this moment as of April 5th. We're saying the property taxes, according to Zillow's estimate, is $500 a year. I'm saying the total insurance, just based on, again, my experience in this, is going to be $800. I'm saying that maintenance will put $2K, as well as no other costs, because we're paying the utility, or the tenant's paying the utility in this calculation based on $1,200. And we are looking at a 21% ROI. That's fantastic. I think that's amazing. I see nothing wrong with that, of course. That's way beating the stock market. But let's assume that, we're saying worst case scenarios happen, right? So I even included management, by the way, property management of 10%. So let's say that you end up needing some repairs of $5,000, which could happen. That's pretty easy to happen. But then your property value increases to 85 when you sell. And let's say that it ends up being 3,000 in maintenance. Well, now we're looking at 16% ROI, which again is still fantastic. And that is being pretty damn conservative here. Now, let's say that you're going through, 10 of these homes, and you are kind of losing track of how to keep track of everything and all the calculations using this website. Well, you have two options. The first is using my referral for Deal Check, link in the description, or secondly, using a rental property calculation spreadsheet that I also include in my mastery program. Now, I'm just using Deal Check because it pulls from public data. In my opinion, it's a little bit easier to keep track of everything, but that is again because I know every single value in this. To a new investor, it might be too complex, in which case I'd recommend the spreadsheet. So let's go ahead and add the property to Deal Check. We'll do import property data, and I'll just put in the exact address here. Okay, it's going to search for it, and it found off of, I assume, Zillow and public data. We're going to use the lower of the estimates because in all honesty, the estimate's kind of bogus. And even Deal Check is saying that to a regular tenant, they estimate it could be $1,060 a month. And that's for a regular tenant. We're saying HUD will be $1,200, which kind of makes sense. HUD tends to pay, that 20% extra. So our numbers are lining up so far. It is stating that on public record, it's actually $780 for the year of 2024 taxes. And it is estimating property insurance to be $540. I actually, again, put a little bit higher at $800. So mine is super conservative. And we'll go ahead and click Save and Customize because there's some stuff that I want to do. So we'll put the purchase price for $80, which is what's stated on Zillow. But we'll say after repair value, again, being conservative, we'll put at $85,000. For this example, I'll just say we're using a DSCR loan since that's what most of you will use. At a 20% down payment at an 8% interest rate. Purchase cost, we'll say it's 8% of the house. Rehab costs, we mentioned already $5,000 with no cost overrun. All right, and now we're saying, again, we already figured out that we would rent it probably to a HUD tenant at $1,200 a month at a 5% vacancy. And the reason it's 5% is because HUD tenants tend to stay on average 5 years, way longer than a normal tenant. Now let's go ahead and take out capital expenditures from our operating expenses because we're not trying to better the house. In fact, we often try to eliminate things. These are cash flowing houses. We're not going for appreciation here. Insurance will raise to $800 a year. And I like to go for the income increase to 3%, but expense increase also to 3%. And now let's go ahead and see the analysis. Now, just a forewarning, it's going to be lower than what the rental property calculator does. Yep, so it's saying 13.3% being super conservative. I think that's fine once again, because we were super conservative. So I would go in on this property if I'm being honest. I would. So I'll add this house to my short list. So now step 4 is we're going to avoid these specific house hunting mistakes that I kind of already went over, but I'm going to give you a summary of them right now. So you're going to want to avoid homes that need major repairs. So if it needs a new roof, brand new electrical, foundation work, I would say don't bother with it unless you're really experienced with burrs or flips, because I typically say that the best way to get this boost in appraisal value, this forced appreciation, is when you add an extra bedroom by, just putting up some drywall, maybe putting a closet and a window, or doing cosmetic work, new paint, new flooring, maybe switching to stainless steel appliances, some new granite countertops. That is what I think boosts the appraisal value the most and what is the best bang for your buck when you're doing these. If something needs a $20,000 foundation fix or a $10,000 new roof, I can't say that it's really worth it for beginners. Maybe if you have 5-10 homes under your belt, then I could say it's worth it. But I recommend find something that needs cosmetic rehab, and you could do forced appreciation or just something closer to turnkey. I also say don't go for these low inventory markets. If there's only a few homes for sale, you're going to struggle to scale. You really are, and you're going to end up being priced out by people buying all cash or these corporations who are paying above asking price. An example of this is somewhere like Akron, Ohio. People were saying, go to Akron, go to Akron. They were saying that a handful of years ago, maybe 2-3 years ago, and guess what? Akron got flooded by investors and their home price shot up $30,000. I believe it went up to from $100K to $130K within 2 years. So if we're looking for sub 100 homes right now, we're only seeing 56 results. I think that is terrible for a town that's that's as big as Akron. This is a city. It really is. So if you're looking for a smaller town, then yeah, maybe 50 would work. But a place as big as Akron, no, you need at least 80, 100 listings. Because these 56 are going to be bought out by all cash investors or corporations. And like I mentioned previously, avoid these bad neighborhoods, these D-class neighborhoods. I think C-class is where we're really aiming with this strategy, but D-class just is not really worth the hassle or the trouble. So like I mentioned, go on Spot Crime, go on Spot Crime, look at the zip code, look at Google Maps Street View, look for boarded houses, trash, beat down cars, and run the other way if you see these types of homes. Okay, so at this point, you should have a short list of 3 to 5 homes that pass your calculation check, that you've noticed are in C-class or better neighborhoods that you want to tour. So if you live near the area or you're able to get out there, fantastic. If you can't, which I imagine is most of you, then you're going to tour virtually. How do you do virtual tours? It's pretty easy. So what you're going to do is you're going to send the realtor your top, 3 to 5 choices, and you're going to say, can you make sure that all of these are fine? And they might strike out a few of them or just give notes on them. But generally, unless something's in a terrible neighborhood, they're going to say, yeah, let's go for these. You're going to tour them by doing a recorded walkthrough by the realtor or a FaceTime if the signal is good enough. So you're going to ask these critical offers if the tour goes well. Are there any pending offers? What are these sellers motivated by? If the sellers really want to leave because their house has been sitting, you could maybe lowball them a little bit, but do a super fast closing, for example. Or if it's the opposite, where they have 5 other offers, then is it even worth the effort to put your hat in the ring? Are there any known repairs or red flags that the realtor sees, especially for Section 8 or just general investments? For example, on a home that a student and I were about to put an offer on, the realtor ended up touring the house for us. Everything was going well, but then they went to the backyard. They saw a broken down, detached garage that was super far in the back of the property. Now, this normally wouldn't be a problem for regular tenants. And in fact, if there was a fence around it or something like that, then you could just write into the lease, hey, tenant is not allowed to access this garage and all will be fine. But since this garage was in the backyard. It was beat down, broken down, and the tenant could easily walk into it. The realtor ended up telling us, and I already knew this, that we're going to have to demo it, demolish it completely, take away all of the rubble if we want to get a Section 8 inspection passing. That would add up about $6,000 to the costs. So that kind of made us think, okay, that's fine. $6K is not a big deal, but we're going to put in it at a lower offer now because we're going to have to put in the $6K to our calculations. And you're also going to want to ask the realtor, double check the comps. Double check that it'll rent to a regular tenant at the price you think, and it'll rent to a Section 8 tenant at the price you think. And again, I already showed you a live example of a house like that. So at this point, I have already gone through the live example with you. So time to wrap up. So at this point, you should know how to find the right property, using a realtor for that property, which again, go ahead and join my mastery program for that, and how to avoid bad deals and just red flags in houses and bad areas. So at this point, you should have a realtor who's actively looking for you and 3 to 5 houses that you have shortlisted and know will work for you. In part 3, I'm going to show you how to make the offers, negotiate deals, and close on the rental too. And again, all of this can be done virtually. So if you are interested in Section 8 investing, go ahead, click the first link in the description, book a free strategy call with a member of my team to see if you're a right fit to join our Section 8 mentoring program where I help one-on-one. Again, I'm not throwing you a PowerPoint and ditching you. I am literally helping one-on-one in order to get you a property purchased and rented to Section 8. Hello everybody, and welcome back to part 3 of my How to Invest in Section 8 Housing Guide. In this video, I'm going to show you exactly how to figure out how much to offer and when to walk away, protect yourself with smart contingencies, negotiate like the pros do, even if you're buying out of state, and how to move fast once your offer is accepted all the way until closing. Let's get into it. As always, I'm Joseph Khateri, realtor in the state of Virginia and Section 8 investor. And now let's go to Section 1, know your market before you offer. So first up, you should pretty much just always ignore the asking price. And the reason I say that is because you can offer whatever you want on a property, and your job is to know how much the home is actually worth and what will work with your numbers. So what you can do is, one tip is you can ask your realtor for a CMA, which is a comparative market analysis. So it's a list of similar homes that recently sold, and not for sale, sold. That's a key difference here. That will look at the price per square foot, how long the home takes to sell, recent trends, are prices dropping, are sellers desperate? So with that info, you can get a better understanding of what the current market's like. So if homes are selling in 7 days, you got competition. If they sit for 60 plus days, then maybe you have a little bit of leverage. I'll be honest though, and you guys aren't gonna like this. If the home you want is both turnkey and under 100K, you'll be going in at full price. That's just what it is. You will be going at full price because the amount of homes that are in the United States of America that are both under 100K and turnkey, they're diamonds. That's what they are. They are rare. There's probably less than 1,000 in the country right now. And guess what? People have money. People want to get in on this strategy. So you're going to be fighting people full price. And here's a bonus tip. Compare the rent potential to the offer price using the 1.5 times rule. So if a 70K home rents for $1,050 on Section 8, then you're in a good zone because 70 times 1.5 is, $1,050. Section 2, decide your max offer first. I mentioned this briefly, but we'll go into it way more right now. So before you get all excited and emotional, you need to know your walkaway number, and that's very important here. So you can use a rental property calculator. I'll link one in the description. However, I actually use a custom spreadsheet I made for all of my students in my mentorship program. I'm not going to use it today, but I prefer using that if I'm being honest. But I'll use just a regular website so that anyone can use it. Before I go to that, let me tell you the values of everything. So you're going to want to plug in the purchase price, expected rent, taxes, insurance. We put aside for maintenance as well. Loan terms and property management fees. So you want at least $400 per month net or close to it, $350 sometimes. But really, since I don't know what your future loan terms will be, we look at ROI for the most part, which is 15%. If a deal has 15% ROI, then I pretty much always green flag it unless I notice something major going on. But it's a price where you can still win even if something does go wrong. So let's say you make some mistakes as a beginner. Well, guess what? Your 15 might lower to 12, but that's still beating the stock market. Plus, as you continue going through more and more homes, you make less mistakes. And a key thing to remember, if the numbers don't work, you walk. That's just what it is. There are always more deals out there. Now let's go ahead and do a live example for you. I always just use Zillow. I don't like going fancy with this, trying to get into custom MLSs or anything like that. Zillow's fine. It covers 95% of the homes you'll ever see. And yes, you might find some good off-market deals occasionally, but those are getting rarer nowadays. And Zillow honestly works fine. So we're going to go ahead and look through Detroit, Michigan, just because that is on my homepage of Zillow. That's honestly the main reason. I don't have some crazy reason for picking Detroit. I could have picked one of the 10 cities that I enjoy investing in. In fact, just so you guys know that I'm not biased, I'm going to pick the one that's literally on my homepage. 75K, 3-bed, 1,000 square feet. Please don't be trash. How's the interior? How's the interior? No pictures. All right, this was a terrible example. Okay, this one's better. 78K, 3-bed, 1-bath, 1,000 square feet. All right, I don't notice anything crazy going on here. Everything looks fine. How's the location? You know what? I showed how to pick location in a previous video, so I'll gloss over it now. Hopefully, you probably already have at least 5 of these types of homes picked out from my previous video. And okay, interior is fine. Nothing crazy going on. So let's look through each of these pictures a little bit closer and see if we can figure out any type of rehab costs. So that flooring is kind of messed up. Maybe that'll require some rehab. We'll see in the future. I don't see anything crazy going on. Kitchen looks beautiful. Oh, you know what? Those cabinets actually are a little bit messed up. So they still look to be in good condition. They just might need some repair. And the flooring. Okay, those two seem to be the major factors here. This shed, it seems like it's in decent condition. I would say that if this was degrading, then it would have to be torn down, but it looks okay. So we'll assume probably about 3K for the flooring and miscellaneous tiny repairs. All right, so we have the rental property calculator set up right now. Again, I use a custom spreadsheet usually, but we'll use this for now. 78K is the purchase price. 3-bed, 1-bath. Okay, that's fine. And let's see the taxes. So you can look them up on the state website. That is going to give you the most accurate number. However, I'm okay using Zillow's just for the sake of time. And it's estimating $1,200 a year. So, oh, perfect. It's already preset, actually. Oh, wait, that's for insurance. Here we go. Insurance, I like to estimate about $800 a year for insurance for a pretty small property like this. For maintenance, I like to just put aside about 15%, which would end up being 15% of the monthly rent. So we'll get to that in a second. No other costs because we will assume in this example, tenant is paying utility mainly for the sake of simplicity. I usually recommend a hybrid model where the landlord agrees to take the utility voucher themselves, but write into the lease that they'll only pay up to a certain amount, up to the utility voucher, and the difference is paid by the tenant. However, if the housing authority that you want to work in isn't really familiar with that, then just putting in the tenant's name is fine. So we'll go to figure out the rental price now. Oh, by the way, interest rate's going to be around 8%. Let's assume you're using a DSCR loan with about 7K in closing costs, which is what I'm seeing nowadays. We're putting aside $3K for repairs, which would up the price to $81. Perfect. So, monthly rent. What I typically do is I go ahead and copy the full address, and then I look through two different websites. Technically the same website, you'll see what I mean. But first, I like to go to affordablehousing.com under Owners Market Rent Estimator. Put in the address right here. It is a 3-bed. So it is saying on average it'll go for about $1,100 just based on surrounding homes. Now, granted, we don't know the condition of those surrounding homes. So we go through a more thorough example here, which is we go to put in the zip code, which is 48205. Now, just to be clear, official comps are supposed to use already sold or already rented homes. But again, since we don't have access to the Detroit MLS, I'm in Virginia, we are just going off of what's currently on the market. And just based on my experience, I'll be able to know something's like grossly overpriced. But we'll put in 3-bed. We'll put in single family only. And this is 1,000 square feet roughly. So we'll look for about 1,000 square feet in very good condition homes. And let's see what we can find. Well, this first one is actually a great example. It's almost identical to our house. Now let's look. How's the pictures? Okay. It is... Ooh, that carpet is terrible. But that's a nice kitchen. This is very, like, You guys notice how flip-floppy this Rehab is? Like, some of it's gorgeous, some of it sucks. That's weird. And this is going for $1,375. Okay, I'll keep that in mind. Let's see. I could use the second home, but I won't because it's a little bit bigger. It's about almost 300 square feet bigger. So I think that's not an appropriate comp. Okay, this one's 1,200. How's this? 3-bed, 1,200, decent square footage, okay? It's carpet though. But, that kitchen's really tiny too. These are just terrible pictures. Nobody knows how to take photos nowadays. Are these all boomers or something? God, that's a terrible attic. Okay, I'm gonna say our home is a little bit better than this. So, just between the two, I'm gonna say we could go for $1,300. So we'll mark that as 1,300. And then put aside 1,300 times 1.5 times 12. About $2,300 for the maintenance. Which, by the way, the calculation I did is the rent times 15% times 12 months. And then let's assume you're going to use management. So they take an average of about 10%. With a vacancy rate of about 5%. The reason I say vacancy is 5 is because we're looking at this home over the course of 30 years. So yes, there might be, 2 months empty up front. However, when you average it out and based on the fact that, these tenants tend to stay for 6 years on average for Section 8, and your turnover is going to be very, very quick considering there's just a huge amount of tenants currently on wait lists. So I'm going to say 5% average throughout the lifetime of this house. We don't know the sell price, so we're going to use the national low average of 3% appreciation. We're going to hold it for 20 years on average, and let's calculate. Okay, so this was a good example. So we're seeing a 20% ROI, and yes, your cash flow is a little bit low. Again, this is mainly because I'm pretty conservative with my maintenance. A lot of people don't factor in maintenance into their costs. I do just because I am like, I don't know. I'm like Scrooge over here, Scrooge McDuck, where I just like need to know the most conservative thing to everything. So if I didn't put in maintenance, then it probably would be the cash flow, which is technically, yes, that is the cash flow. It would be, 400, almost 500, like $500. But I put in or I put in maintenance. I feel like $200 of maintenance a month is kind of normal. So I don't want to fool you guys. I don't want to do any weird tricks or anything. So yeah, 300 is about normal, but this 20% ROI is insane. So I mainly like to look at the ROI because, again, you're only putting 25K into these deals. 25K for a $300 return. That's insane. If I'm being honest, like, you can't get that with any other strategy. And I know it doesn't sound like a lot, but again, this is 25K. And I know that's a lot to some people, but when you're looking at like stocks, for example, it's not a lot. So now you got to figure out what your maximum rent price is, or maximum purchase price. Really, how you figure this out, simply up the purchase price until it hits about 15% ROI. So let's put it at 85. And that would up all of our numbers. This would go up to, let's say, 88. And the reason I'm saying that the value would raise is because, obviously if this home is listed for 75 or 78, whatever, and it's going for higher, it's because people perceive it and its value is higher. It was underpriced. So we're assuming this, you're looking at 18%. What if we put it to like 95? 98. Okay, that would put you at 16. So we can assume that the maximum price would be somewhere around 100K for this home that I personally would offer before I'm like, whoa, back up, buddy. Or you can really just view it as another opposite side of things, or another strategy is, does it still fit the 1.5 times rule, which is the rent price has to be at least 1.5% of the purchase price. And in this case, 100K would actually be a little bit too high. That'd be 1.3 times. So realistically, it would be, let's see, it'd be what, 90? 90 times 0.015. Yeah, it'd be about $90,000 just for that math. That would be the maximum price for this home. So if you want to be more conservative, do the 1.5 times rule. That would make more sense for a conservative answer. But again, I want to preface this and say, if you're going for very good condition homes under 100, you'll be paying full price. There's not really a whole lot of negotiating power unless it's distressed. If it needs some work, then yes, you can probably negotiate a little bit. But if it's gorgeous, I mean, there's not a whole lot you can really do because it's going to get 5 offers. Section 3, structuring a smart offer. So let's talk about what goes into an offer that protects you, but will still get accepted. So here's what you're going to include in your offer. Inspection contingency. A lot of people don't like it. A lot of people disregard it. They say it's not worth the time. Whatever the case is, I always include it, even if it weakens the deal. And I know that's not something that people want to hear, right? A lot of realtors, especially in this business, will go, "Don't do an inspection. Don't do an inspection. You're never going to get an offer accepted. Do an inspection." I don't care what they say. I'm a realtor myself, and I'm saying do an inspection. I typically do a 7-day because people's schedules are busy. Some inspectors can't get out there for multiple days. So do a 7-day inspection, a 7-day inspection period, sorry. And during this inspection, you want to write into the contract that it is an option to negotiate or avoid. It's not going to just be an option avoid. It's not for information only. It is an inspection contingency with option to negotiate or avoid. And what this means is that when you do your inspection, you can go back to the seller and say, "Hey, fix these 10 things we found," or, "Hey seller, we found these 10 things, lower the price by 5K so I can fix them myself." Will they say yes or no? Well, that's up to the negotiations. They can say no to everything and say, "Move along, bucko, we'll get a different guy." But you at least have the power. You have the option to negotiate. Or, again, the second part of it is option to void. You can simply back out of the deal if you don't like it. And that's really all there is to it. Now, what do you do if, let's say, putting in inspection contingency will definitely lose you the deal and you really want it? Let's say that there's 5 offers on the house already. What you do in this scenario is you just blatantly tell the seller. You try to outbeat everybody with whatever the seller wants. You're going to just directly say, like, "Hey, I have an offer that's probably going to beat all your other offers. Issue is I definitely want an inspection. So I don't waste your time or my time, can I have an inspector go out there just during the tour so that I can really see if this is even worth me putting an offer in or not? So that is what you can do. It is not going to be an official inspection written in the paperwork. There's not going to be an option to, go negotiate or anything like that. But you can at least know, like, if you're about to put in an offer with no contingencies, you at least will know that that home is worth going in at based on at least an inspection standpoint, because you already did it kind of during the initial tours. So that way you know what the issues are before going into it. You know how much the estimated rehab will be. Will they fix any of it? No, because it's being sold as is. But at least you will know. Second contingency, financing. So you only include this one if you are required to by a lender, or if you are just using a loan in general and want it. So the financing contingency is it's a contingency that says if your financing as a buyer falls through, then the contract is voided. If you don't have this, that means if your financing falls through, you are still obligated to buy this. I know that's crazy, right? How am I going to buy it if I don't have a loan? They're going to make you. So you're going to have to come up with cash or you get sued. That's basically how it is. Now, just to be clear, a lot of lenders will actually require this. And it makes sense, right? They don't want to get sued. They don't want you to get sued in case the financing falls through. So if your lender requires it, is what it is, put it in there. Now you're also going to include an EMD, an earnest money deposit. It's exactly what it sounds like. It is a deposit on the home. It's usually $1,000, maybe $2,000, usually 1% of the purchase price. But when you're going for homes under 100, we don't go below $1,000 usually. It is held in escrow. It doesn't disappear in thin air. It is used towards your closing costs. So it's just held by a title company. And then they're also going to make you include a proof of funds or pre-approval. No seller is going to take any offer seriously without this. So proof of funds is what it sounds like. You need to prove that you have the money that you say. And this usually means a bank statement. That's usually what it means. And that is if you're going for a cash deal. If, again, you're using some type of financing, that means a pre-approval letter given by your lender. And my DSCR lenders are going to be able to provide this easily. We usually do it within just a few hours of you telling us the address. Now, have your realtor call the listing agent before submitting. And the reason I say this is because they should ask a few questions. Why is the seller selling? That is a huge one. If they are selling because they're moving to Chicago and they need to sell the home as quickly as humanly possible, well, then guess what? You might be able to get in at a better price, maybe $5,000 under asking, if you put in a super fast 14-day close. On the other hand, if they say, oh yeah, we just want the most amount of money possible, and you know that they have offers already going for $5,000 over asking, $10,000 over asking, then you have to ask yourself, is this even worth my time? Do I even have any type of leg room here to put in my offer? And that'll happen a lot. And the answer usually, admittedly, is no. Now, based on those results, you can adjust your offer. So, hot market means that you're putting in offers probably on full price or maybe even a little bit higher. Cold markets mean that you can ask for seller credits, a rate buy down, or just a general lower offer. Now, the next section, how to negotiate like a pro. Offers are not one size fits all. This is where your realtor is really going to shine and pull in their expertise. So to negotiate smart, even remotely, you want to don't lowball unless the home has been sitting for a while. If this home has been sitting for, like this one on screen, 5 days, is under 100K and is in great condition, don't lowball this because you're not going to get an offer accepted unless they have no other options. If they have no other, and the sellers, the listing agent will say this, if they have no other offers or nothing really on the market, and even Zillow is saying this wasn't here, then yeah, maybe you could lowball. But you can't on this one. Be realistic, guys. Zillow even says it'll probably sell fast. And with your lowballs, you want to be aggressive but not insulting, right? So what I like to do is I like to pretty much go at the minimum purchase price that my loan would still get accepted at. A lot of DSCR loans have a purchase price minimum of, let's say, 100K, 120K, 150K. Now, thankfully, my lender in my mentorship program for all my students can go down to 75K purchase price. So if I really wanted to go on this property, and let's say that this was sitting for 60 days, and I knew that there was a little bit of rehab, probably 3K, I would probably put in an offer at 70K. I'd go in at 70K, and they'd probably counter. My lights just flicker. You guys saw that? Okay. I'd go in at 70K. That'd be my initial offer. They would probably counter with, let's say, 75 or full price, and I would try to get them to go to 72. And the reason I say 72 is because my DSCR lender can still approve purchases as long as there is and I'm talking about refis here, as long as there is receipts of rehab being done, and we're assuming 3K in this one. If I was doing a regular purchase, not a refinance from using private money or cash, then I would probably still offer 70, and then I'd have to get it to 75 usually. Now, granted, what do you do if the home, for example, they accept the 70, right? Like, what happens then? Oh, shoot, my loan won't get approved. Well, what you should do is you should say, hey, we can make the purchase price 75, but give me 5K in seller credit. That way it evens out, because the purchase price is still 75, but they just pay 5K of your closing costs. But again, you'll probably be going full price on most of these homes because a lot of them are in good condition and cheap. A lot of the time, you can also incorporate a home warranty into the purchase offer. They're usually around like $700. You can say it's paid by the seller. It's just a little bit of like reassurance. If you have a strong offer, you're already beating the competition, go ahead, put in a home warranty on there, paid by the sellers. That way you get a little peace of mind for the first year that you own the home, that any major issues that happen or occur, you're covered by, usually an $80 deductible, something like that. Now, let's say that your offer got accepted. You went in, let's say, full price or negotiated, whatever the case is. Everything's all good on the lender side. You're getting a home warranty. Congratulations. What do you do with the inspection? It's a 7-day inspection. So what you do is you either use the realtor's contact or you use my contacts. Again, I offer them in my mentorship program. The inspector will go out within the 7 days, inspect whatever their heart wants. You can either be present for it or do it all remotely. Either way, they're going to send you a huge report. It's probably going to be 30 pages of everything they find. And most inspectors are already going to be finding stuff that is, related to Section 8 because, well, Section 8 at the end of the day is a housing quality standard inspection, meaning they look for anything that is basically making sure the property is in a livable and safe condition. And that is basically what the inspector is doing too. They're going to point out loose doorknobs. They're going to point out cracks in foundation. They're going to point out loose guardrails. Basically the same stuff the inspection for Section 8 is going to do. So you get this inspection back and it says, wow, kablamo, there's 50 things wrong, completely normal. What you want to do is you want to go through the inspection with your realtor, or if you're a student of mine with me, and we're going to point out what's really the major problems here. So if you see any, and I'll give you some examples right now, any roof damage, you should get a roofer out there. Get a roofer out there to do some inspection, especially if it's, decent damage. If you see foundation issues. So typically, the home inspector and realtor will be able to at least say if something should be looked at further, or if something is just like the concrete settling. Now, a lot of the time with older homes, you will see these foundation issues, and that's completely normal. In which case, you should get a foundation guy out there, which, again, a good realtor will have a contact for that. And the last thing that I look for is water damage / mold. They kind of go hand in hand because water damage causes mold most of the time. In those scenarios, you have to get a mold guy out there. It is no longer just oh my god, the roof might leak, whatever the case is. Oh, we might have to replace the roof. No, this is a health hazard now if there's mold / water damage, because that stuff will ruin your lungs and has a lot of unknown health drawbacks to inhaling. So yes, get a mold guy out there immediately if you find it. Most of the time, the sellers really don't like mold either because they usually have to disclose it legally. Like, let's say you back out of the contract and the next schmuck comes in, they have to legally now disclose that there is mold at the property, which kind of hinders a deal. So a lot of the time, if you find mold/water damage, the sellers will work with you, whether it be they'll fix it themselves or they're going to reduce the price in order for it to get repaired by you. But either way, very, very dangerous things. You definitely need to take it seriously. So let's say that you find some roof damage and you find some mold/water damage, and you go back to the sellers and say, hey, I found these 2 major things. The other 48 things I don't really care about, but these 2 big things are major and I want $5,000 off of the deal. They can either say one of 3 things. No, can't do much about that. If they're firm on it, you kind of just have to move on. Number 2 is they could say, sure, we will lower the price $5,000. 3, they can say, no, we will fix it ourselves. We'll keep the same purchase price. We'll send you receipts of the invoices that are completed with licensed contractors. That still works out. Or 4, and I just thought of this, they could counter. They could say, we'll lower it $3,000. And then you have to look at your numbers and see if you're still hitting around 15% ROI. If you are, typically you move forward. If not, then what's done is done. You move on. This is a numbers game after all. This isn't something to get emotional about. Section 5, you're under contract. Now what? I kind of already talked about the inspector side of things, so I'll just mention it briefly in this one. But I'm going to talk about the overall steps. So from beginning to closing, basically. So first thing you're going to do immediately is sign the paperwork. That's easy. It's going to be a few signatures. Then you have to submit your earnest money deposit. This is typically going to be whatever you wrote in the contract, $1,000 or $2,000. And you can either submit it via money order, wire transfer, or a lot of title companies will be able to do it through an app. That's the method I like the most because I'm a lazy man. I don't like doing things complicated. So just using an app, submitting it, super easy. So that's going to be the first major step. And by the way, if you back out of the contract, you get this money back. You get the deposit back. They usually ship it via a check in the mail, and it takes about like 2 weeks. Second thing you have to do, schedule your home inspection. I'm recommending to do it within, to put in a 7-day clause. So hopefully they'll get out there in, 3 or 4 days in order to do an inspection and leave you a little bit of time after. Once you do your inspection and you can see the numbers and have them work out, the sellers are agreeing, and the inspection period ends. Let's say you got the price down another $5,000 or whatever the case is. Now you have to coordinate your contractors. So let's say you found water damage. You have to get a mold guy out there, a plumber out there, and then probably a general handyman in order to clean up the wall after. So let's say you also found some roof damage as well as some GFCI outlets that need to be repaired. You're going to get a roofer out there. In order, you can't do it yet. You have to do it after closing, but you're going to schedule it for after closing. And then you're going to make sure you have a good handyman on speed dial for the littler things, filling in some spider web cracks on concrete, maybe tightening up some guardrails, changing some outlets. And you're going to make sure that all of your quotes are coming in at appropriate prices too. The last thing you want is to accidentally, go over your budget before you even finish closing on the house. So what you want to do is, how do you find these contractors? I think I've mentioned this in previous videos, but it's very simple. Ask your realtor. The realtor you use, hopefully through me and my program, will have contractors that are top tier. They're going to be the best in the area, and they're going to already know your realtor, so they're going to make sure they do good work, or else the realtor's not going to use them again. That's just how it is. This is a relationship business. If you do someone dirty, then they're never going to ask for your help ever again, and you lose business. And I always say get multiple quotes. You shouldn't just stick with the realtor's recommendation. While it is usually one of the best ones, you should still find 2 other quotes minimum. I always do 3 quotes for any major repairs, so anything over like $300. Make sure everything is good on the lender side. They're most likely going to ask for a lot of documentation. It is what it is. They're going to make you sign a bunch of forms, ask for more bank statements, etc., etc. Just do it. You want to make sure everything on the loan side is great because it is a headache if you're dealing with it, 4 days before closing. You want to make sure the appraisal gets ordered as well as an optional land survey. I never do the land survey, but you can. But the appraisal is serious and it usually is the longest process for the loan itself. Sometimes it takes 21 days. So you want to do that ASAP, like as soon as you know that you're committing to the property. Then you want to transfer utilities into your name for right after closing, and then get your property manager looped in the entire time so that they are ready to rock and roll as soon as you close. And the important part of making sure the utilities are in your name is because let's say that you're buying in February. Well, guess what? If they're not and you don't have water running, the pipes might freeze. Or let's say that you are about to start rehab or get your home inspected and they need the water. Guess what? They don't have it. They need the electricity to plug in their power tools. You don't have it. Okay, so I think I covered everything for at least this part. So now you should have a strong, confident offer on your first or next Section 8 rental. So in total, you have learned how to value properties and avoid overpaying, how to structure and submit an offer the smart way that will give you the best chances, how to negotiate without being greedy and making sure both sides succeed here, and what to do as soon as you're under contract all the way up until closing. So go ahead and drop a comment below if this helped you or if you have any questions. I still reply to most comments. And if you're interested in receiving my one-on-one mentorship, click the first link in the description. It is going to lead you to my website where you can book a free training call with my team to see if we can help you. If you want access to my free community, go ahead and click the second link in the description. It's going to lead you to School, SKOOL. And in it, I have a community of fellow investors that you can chat with, that I'm going to make, that I have custom content in as well. And every single month, I'm going to be doing a live call where you can go in, ask me any questions you want, and see how I do things live. Next up is part 4, Rehab and Management. Welcome back to part 4 of my Section 8 Mastery series. You've made it this far, picked a city, got financing, made the LLC, found a house, made the offer, and now the real work begins. This is where most new investors end up messing up the most, and it hurts their bottom line, which is rehab and property management. In this video, I'm going to show you exactly how to hire reliable contractors who don't rip you off, rehab your home to pass the Section 8 inspections, decide whether to manage it yourself or hire a company, and how to get your home rent ready without wasting any money. Part 1. Understanding Section 8 rehab versus regular rehab. Let me be clear. A Section 8 rental does not need to be a luxury. It needs to be clean, it needs to be safe, it needs to be habitable, and it needs to pass the Section 8 inspection, and that is it. Now, what do these Section 8 inspectors focus on? They focus on the number of bedrooms. They focus on electrical outlets, no leaking pipes, carbon monoxide detectors, smoke detectors, no peeling paint, no water damage. Every door must open, close, and lock. Every window must open, close, and lock. No exposed electrical wiring. Hot water should be working. HVAC should be fully functional. Working toilets, no tripping hazards. And honestly, that's most of it. They're not going to care about walk-in showers or granite countertops in your kitchen that you just remodeled. And in my personal opinion, I believe that if you're a newer investor, then I recommend going for homes that are turnkey or at least close to it. And the reason I say that is because you don't want to be dealing with a full $20,000, $30,000 rehab when it's your first property, because $20,000, $30,000 in rehab could very much turn into $50,000. Really what I'm saying is you want to choose the turnkey home starting out just so that your risk goes down. And because if something goes wrong, I don't want you to have a bad taste in your mouth that this whole strategy doesn't actually work, when instead you just did a really poor job at estimating because you're brand new. Some more examples as to what regular rehab might include versus Section 8. Regular rehab, you might want to focus on the amenities, making sure everything is that quartz look to it, making sure that there is those waterfall showers or all the screen doors are in place. They have really nice ceiling fans. Whereas Section 8 is almost the opposite, where you want to strip away everything that isn't necessary. So no walk-in showers, no garbage disposals, no dishwashers, no screen doors, no ceiling fans, and whatever that does remain and is required by the Section 8 inspection, we make it super high quality. And let me show you guys that you can actually, again, just find the inspection checklist online if you Google HQS inspection checklist, and it'll be these two links right here. So this one right here is what the inspector is physically going to have when they go out to your property, and they're going to be able to just check off what you have and don't have. However, I don't actually think this is the best resource for newbies because I think this is very non-explanatory. So instead, I like to use the second link, which is the inspection form, because this has the explanations on it. It's 19 pages long, so yes, it is kind of a doozy to read. By the way, if you're in my mentorship program, I give you a better checklist to use instead of this 19-page one. So if you go through this, you can directly see everything that's necessary. So for example, the living room. I see that electricity. In order to qualify, the outlets must be present and properly installed in the baseboard, wall, or floor of the room. Do not count a single duplex receptacle as two outlets, i.e. there must be two of these in each room, or one of these plus a permanently installed ceiling or wall light fixture. Now, if you read between the lines, that also means that you don't need a ceiling or wall light fixture as long as you have at minimum 2 working outlets. So that's the other side of this, right? So you don't even need, not only do you not need a ceiling fan, but you also don't need a light. You know, it can be exactly like how I have it in my room where there's no light here. There's just a bunch of outlets. So this is 19 pages long. It goes through every single thing you possibly could need. Window condition, lead-based paint, that one's super important. Chipping paint's a huge deal. You always want to make sure that's always gone. And yeah, it just continues on for every single type of room. This is the kitchen, this is the bathroom. These are hallways. Section 2, how to find and vet contractors so you don't get scammed. You don't need to know a roofer in Detroit before going into this. You just need to know how to search things up. So I always like to get 3 quotes for every single work order that comes up. So the first one, I always get from a realtor, and the realtor I recommend you is going to have their top guy. For example, I'm in Fredericksburg, Virginia. I'm a realtor in Fredericksburg. I automatically know off the top of my head my top guy for roofing. Same with plumbing, same with electrician. So whatever realtor you end up using, I'm confident that they will have their recommendation for property managers, contractors, etc. What do you do about the other 2, right? Because I don't like to get every single contractor just from my realtor. I like to only get a handful. So the other 2, and I know this kind of sounds silly, but you join the Facebook groups of that city. So let's say you're looking in Detroit. I will straight up go on the Facebook groups called Homeowners of Detroit, right? Detroit homeowners, Detroit investors, groups like that. And I will simply make a post saying, hey, I'm a new blah, blah, blah in the city. I am looking for the cheapest but reliable plumber out there. I'm looking for the most reliable roofer out there who's not going to cheat me. And you just make that post, and I'm fairly much guaranteeing, I'm pretty much guaranteeing that you're going to get, 5 to 10 comments of people recommending who they think are the best roofers. So you're just going to call every single person up, including the one your realtor gave you. And that's about it. You're just going to dial them, ask them to give you a quote, and there's not much more past that. Of the 3 quotes that you get, you choose whatever you think is the best one. Now, best does not automatically mean cheapest. I just want to point that out. I've gotten many quotes where some guy was, $200-$300 less than the competitor, but they were not insured. They were going to take longer. They had mixed reviews. So cheap does not always mean that they are the best. And let me go ahead and prove this right now. So I am in my Facebook groups right now. All right, Fredericksburg Real Estate Investors Meetup. So I'm a part of this group. I don't actually go to this investor meetup anymore, but let's see, search bar. Let's look up roofer. Is there anyone for roofer? There we go. Would you look at that? On June 29th, which was, oh my God, not that long ago. That was like 2 days ago. Looking for a reliable and affordable roofer and foundation chimney expert. And would you look at that? There's 26 comments So yes, this definitely works, and you want to make sure that you get multiple bids. And I mean, even this comment says get multiple bids. Make sure this company is one of them. So I finding contractors is way easier than people think, as long as there are people recommending them, right? Referrals is a huge part of this. And also just you can compare their exact quotes against each other. Now, let's say that you don't have a realtor through me, right? You're not a mentorship student and you ended up, let's say, buying this off market, or you just went through a realtor and it was a crappy realtor and they don't have any recommendations. What do you do? Well, unfortunately, it kind of boils down to cold calling past that point. So you can go on, really, it's just Google the city, space, what contractor you need, Fredericksburg Roofers, for example. And I always stay away from the big names. So if they are a chain, they are not a local place, then I avoid them. I only go for local, well-reviewed places. For example, this one right here. This one is M&D Roofing and Renovations. They are local and I have used them before and they are pretty good. So shout out to you guys. But this is an example. Now, what do you also ask these contractors? Are you licensed and insured? That's a big one. Have you worked on investment properties or rentals before? Do you have photos of past work? You always want to make sure that any quotes you get are in writing via text or email, and you want to make sure that they include the materials and the labor in the quotes. And do you offer a warranty on your work? Now, some red flags to avoid. If they don't give a written estimate of any kind, they want full payment up front, or they can do every single thing, even things that are way more specialized than a handyman could do, or they have like no references or portfolio. Now, let me go ahead and explain some of those, right? So no written estimate. What happens if stuff goes sideways, right? They aren't showing up, etc. Well, you can't do a chargeback, or you can't even take them to small claims court if it's a bigger quote. If you have no proof that they were going to do any amount of work for a given price. So you want to make sure it's written. And the second is that when they say they want payment upfront, now they have no incentive to finish the task on time. So you want to make sure that they don't take more than about 50%. They can do 50% upfront, 50% at completion, and that would be fine. And you can also say that if there is any type of delays or any type of work not completed by a certain date, then they simply are paid less. For example, let's say $500 is upfront for the deposit. $500 is due on the 10th, which is the completion date. If they themselves don't get the work done until the 15th, not due to anything on your end, then say you'll only give the remaining $400 instead of $500. Now, I also mentioned don't get someone who can just do everything. Now, I like handymen. I think that they are a great bang for your buck, and I very rarely have a bad experience with them. However, I am not trusting a handyman to do some crazy stuff like get me a new roof. Like I'm not doing that. I'm not going to get a handyman to go and replace my copper piping. Like, no. Like, would you let a dentist do your taxes? No, probably not. And maybe that's too extreme of an example. Would you let a college student do your taxes? A business college student do your taxes? No. They might technically be in the same field. They might understand what it is. But to get something that intricate and honestly important done, you should go to a professional that is licensed in that field. But again, if it's not something specialized, I have no problem getting a handyman to, replace some railings, paint, drywall, etc. Even sometimes replacing easy leaks, right? Like pinhole leaks. So we'll move on to section 3, which is budgeting and managing your rehab. Now, let me go through some of the typical turnkey rehab costs that I see on the market on average. I see paint and flooring roughly be $3,000 to $6,000, and this is a home assuming that's like 1,200 square feet, maybe 1,000. And again, this honestly heavily changes depending on the area you're in. For example, some of my students in Detroit have higher costs than my students in Birmingham, but in return, Detroit has higher rents, so it kind of evens out. So yeah, paint and flooring, $3,000 to $6,000 on average. Some basic kitchen updates I've noticed can be around $3,000. A new water heater, you can buy them new for around $600 to $800, but then you also have to factor in the cost of labor. So that bumps it up to usually $1,000, maybe $1,200. if you want a roofer to go out to your roof and, replace the shingles, basically try to squeeze a few more years out of it, I've noticed that's about $1,000. And even on the most gorgeous turnkey homes, I still notice about $2,000 in rehab that's needed. It's typically for things that you might not even see with the naked eye, but definitely matter for the inspection. For example, we had a warning from an inspection a few weeks ago with one of my students. And the reason being was the lawn wasn't mowed, which I thought was ridiculous. It was only about 3 inches tall, and the city doesn't even care until 6 inches. I don't know why that one failed. That was just like a stubborn inspector. Should have brought a box of donuts out to him. But another inspection that we had, the tub had chipping paint, and that was very easy to fix. However, it was just something that ended up delaying things by about a week. So it's just stuff like that, right? They add up. The lawn, the chipping paint, that was like $200-$300. If some of your GFCI outlets don't work, that's a few hundred more bucks. So I've noticed that on the high end, even the most gorgeous turnkey homes still have about $2,000 in work that need to be done just to get it past the inspection. So your order of priority should basically be, the top should be anything that fails the Section 8 inspection, followed by, and in that, you'll have safety hazards such as trip risks, mold, broken windows. Then you'll also include basic livability, so paint, flooring, doors, and then appliance install. So last I checked, appliances are not required, pretty much in any way. However, if you do supply them at the beginning of your lease, then you have to upkeep them throughout the lease. So for example, if you supply a fridge and stove on day 1 of the lease and it's included in the lease and it breaks 6 months later, that is not the tenant's responsibility. It is your responsibility as the landlord to upkeep the appliances. Now you might be wondering, oh man, why doesn't every landlord just not include any appliances then? Let's just leave it all for the tenant. Well, it makes it a less desirable property because now the tenants need to pay, they know that they will have to bring in their own appliances and it costs them an extra $1,000 on their back end. Or B, Section 8 will simply pay less. So Section 8 has something called a utility voucher, which includes a line that says, if you have a fridge, we'll pay you $20 a month extra. If you have a stove, we'll pay you $25. And let me go ahead and show you it as well, so you know that I'm not bluffing here. So this is the Cuyahoga Metropolitan Housing Authority, so basically Cleveland, Ohio Housing Authority. And we'll go to housing, go to the rent. Let's see, scroll down right there, HCVP Utility Allowance Chart. And in it, let's go ahead and zoom in quite a bit here. We can see exactly what Section 8 will pay for certain utilities, so such as natural gas, or an electric heat pump. However, I want to go specifically to right here. If you have a range for a 3-bed, that will pay an extra $21 a month. If you have a fridge, it'll be $25. If you pay the trash, it'll be $9, etc. So it looks like range and fridge are the two that they provide here. So I personally wouldn't include, for example, a dishwasher. I wouldn't include a garbage disposal. I wouldn't include a microwave because, again, they won't pay any more for that. Now, a big pro tip in order to get these appliances for just super, super cheap is you want to make sure that they're decent appliances, first of all. I'm not going to get those, super old crappy ones for $50 because they're just going to break in a year. So what I like to do is I like to make them decently high quality because the kitchen is easily the best selling room of any rental. If you make the kitchen look gorgeous, 9 times out of 10, the tenant's going to care very little about anything else. So how do you find these decent appliances? Well, you can just go on, once again, Facebook. I know I keep mentioning Facebook. I don't even really like Facebook that much, but they do have a fantastic old people community. What do I mean by that? Well, everyone on Facebook Marketplace just sells everything, and most of the time it's boomers. So if I just look up fridge, in Fredericksburg, within 30 miles, you'll see so many decent condition stainless steel fridges for pretty cheap, sometimes even free. So let's look at some of them. So this one is a very nice stainless steel Samsung fridge. This thing looks huge. It's also a freezer. It has a working ice machine and it's only 400 bucks. And I'm willing to bet that a Samsung stainless steel fridge is way more. Yeah, $1,000 minimum, it seems, for a fridge like this. Now, would you look at that? Here's an even better one. So this one is definitely smaller, but if it's a small rental, maybe 1,000 square feet, 900 square feet, this could definitely work. This one is only $110. Now, what's this one? Okay. Look at that. This one is $150, and it is, again, a Samsung. It is an older Samsung, but it is still a Samsung stainless steel fridge, has some cosmetic defects, but it's $150. That's insane. So my point is, it's not that hard to save money on these things, so you may as well include them. You're going to save 50 bucks, but in return, you're potentially going to lose good applicants. Why would you ever do that? You can also go on some used appliance stores. So for example, I know Discount Appliances is a pretty big one near me, and I think I've bought a stove from them before. And it's simply put, it's just used appliances. They're usually decent condition, and they are usually coming with warranties as well. So let's look at a fridge. All right, so let's go by low to high pricing. You can find some cheaper white fridges, which I don't really recommend those, if I'm being honest. They just don't aesthetically look that good. But we do see some other ones. So for example, this one right here, it's $225. That's a Frigidaire stainless steel. Right next to it's a Kenmore for $225. Oh look, and even right here, a Whirlpool, again, looks like stainless steel, $250 range. Looks like it's electric. You get the point. Moving on to section 4, which is how to actually pass these section 8 inspections. Because newsflash, if you can't pass the inspection, you will not get paid, unfortunately. I know free money is fantastic. I love free money, but you won't get paid. I want to pause quickly right here, and if you are enjoying this video, enjoying these full-length guides, etc., I actually offer one-on-one mentorship where I will literally hold your hand, coach you, teach you, educate you on everything that you need to know for this strategy, all the way from picking a city to managing the property. I mean, you can even tell this is part of a full-length, like probably 4-hour series. So I, kind of give it up my all, don't gatekeep anything. So if you are interested in probably saving yourself tens of thousands of dollars in potential mistakes, click the first link in the description because that'll be a link to my one-on-one mentorship. You can apply there and get into a free call with my team, or click the second link in the description if you are at least interested in my free community, because in my free community, you can talk to fellow investors. And on top of that, we also have a bi-weekly, every Monday, every Friday, live Q&A call with me. It's on Zoom. So go ahead and click the second link in the description if you are interested in that. All right, back to the video. So how do you pass this Section 8 inspection? Well, I have a foolproof strategy. First thing you do is you do your own self-inspection. How do you do your own self-inspection? Well, it's using the forms that I previously mentioned. I like using the inspection form page instead of the checklist page, as I mentioned previously. But you literally go out to the property yourself, get a handyman to do it, get a property manager to do it, or pay a realtor to do it. One of those 4 options. And you will just bring the inspection form with you and directly do your own self-inspection, right? You do it one time you do it a few times. So you do it once as soon as you close on the home. That way you know, okay, what failed and what will I need to rehab because of this? That way you'll know, I need to get a plumber out here to fix the leaks. I need to get a handyman/painter out here to get the chipping paint covered. I need to get a handyman out here to fix the railings. So that way you know what needs to be directly fixed. Then let's say 2 weeks later, the rehab's done. You do it again. Exact same thing. Make sure nothing was missed. Check over all of the work. Again, get a handyman to do this, property manager, etc., to go out there. And just make sure that it will now pass according to your standards, according to this form. Afterwards, the actual Section 8 inspection will happen. If at all possible, get someone to go out there, it can be you, property manager, etc., and give them a coffee and a box of donuts. I'm being so serious about this because that will automatically put you on a good note. Honestly, you might be let off with a warning instead of like a full rejection a lot of the times. Or if at least you are being rejected, they will take the time to explain why it's happening and what you can do about this. So it just gives you an edge up compared to anyone else. Now, let's say that you pass the inspection at this point. Oh, and I'm sorry, I forgot to mention this. Sorry about that, but some of the rehab that you also can do that will definitely save you money in the long run is replace any carpet with luxury vinyl plank. And the reason I say that is because luxury vinyl plank is way more durable, it is waterproof, and it lasts usually triple the lifetime of carpet. Yes, it's usually about, I want to say like 40% more in cost, but if it lasts for 3x the amount of time, it just is a no-brainer to get luxury vinyl plank. Plus, it typically elevates the look of the home and can usually get you an extra like $50 in rent. So completely worth it in my opinion. You can also get all of the light bulbs to be LEDs because that it means they're using a lot less wattage, which lowers the electricity bills. Make sure all of the toilets are water saving, low flow toilets. They are a little more expensive, but they'll usually pay themselves off within a year. You want to put fresh caulk on all of the tubs, sinks, windows. That way it helps at least for the windows, traps air a little bit better. And for the tubs and sinks, it prevents future leaks from happening. In fact, I'm dealing with that right now. There is a caulking issue with our one of our tubs in our rentals, and it is causing a leak to go down from the second floor to the first floor. It is very annoying. But yes, fresh caulk definitely helps a lot. And make sure that if you are within 6 feet of any water source that you are using GFCI outlets. Sorry, just wanted to put some of those money-saving tips out there before I continued yapping. So once you have passed the inspection, right, the donuts helped or whatever the case is, you are now ready to advertise. And I will go into that in either the next video or just later in this one, because now we are onto the step of, should you even hire a property manager in the first place? So the house is ready to rent, right? Who's going to manage it? Are you going to manage it? Is someone else going to manage it? Is your cousin Daryl going to manage it? Well, here are the pros and cons. When should you self-manage versus hiring someone? So, and I'm going to read off some notes here. You should self-manage if you live nearby. That's pretty much a given. You're handy and can do minor fixes. You want to save the 8 to 12% fee. You're okay to take tenant communication via text or email. And when to hire a manager. If you live out of state, however, I'll talk about that more in a second. You're busy with your other jobs, W-2s, etc. You don't want to deal with any type of paperwork. You want someone else to handle the rent collection, notices, and maintenance. So if that kind of sounds like what you want, then yes, you can hire a manager. Now, what are the good things that the property manager does in the first place? Well, they list the home and find the tenants for you. Yes, they charge you money for this. They will handle showings and move-ins. And I'm reading off some notes again. Coordinate with the housing authority. They will schedule inspections, manage maintenance, and handle evictions if needed. And again, any good realtor is going to automatically have their recommended property managers. This is no different from finding any other contractor. You want to find 3 different managers, 3 different quotes, and go off of that. You can ask Facebook for 2 of them. You want to compare all of their fees, what their contract looks like, and what are the average days on market for regular rentals and Section 8 rentals. And please, for the love of everything, make sure they actually have Section 8 experience, because the last thing you want is to hire someone and they're like, yeah, we only have 2 Section 8 rentals. We don't really know what we're doing or what the processes are or how to do things efficiently, right? That would just be terrible. You want to make sure that they have at minimum like 20. And that's the low end of how many Section 8 homes they should have. Now, what do you want to do if you want to handle the management yourself? Can you even do that if you're not in the same state? Of course, yes, 100% you can, right? I personally am about to fire all my property managers at the end of the year because I'm going to start managing it fully myself, because I already basically am. So what do I mean by that? I think property managers are good for a few scenarios. I think that they are good for collecting the rent, listing the home, doing the showings, handling late fees. I think that's it. Everything else they're pretty just terrible at, or just mediocre, or basically trying to scam you. Oh, they're also decent at handling evictions, but I'll get into that. I've now identified the few things that the property managers are good at. Well, guess what? There's property management software for like $20 a month that do all 4 of those things, right? So I'll give you some examples. If we go on to Rent Spree, this is a website that I still use to this day, and it is perfect for handling all applications. So you can do the rental application through it, the credit report, background check, eviction history, and income verification. It is $50 per applicant. However, the applicant pays for it. You don't pay for it. You just write down on your listing, application fee $50, and they will pay it. Rent Spree, that's how you screen tenants. You don't need property managers for that. Oh, but Joseph, how do I even list the property on Zillow and affordable housing? All you need are iPhone pictures. This isn't a $1 million mansion being sold. This is a Section 8 rental. As long as you have clear iPhone pictures, that is all you really need. You can pay your realtor $100 to take them. You can ask a handyman to take them for you. You can go there one time yourself and do it. There's a lot of different combinations. You can even hire a professional photographer and choose their cheapest package. Usually it's going to be like $200, and they'll actually use a DSLR camera. So there's a lot of different ways you can go about that. So that's not really an excuse to solely hire a property manager, because keep in mind, property managers take the first month of rent as payment. The first month of rent is usually $1,400. So just keep that in mind. If there's any way you can do it yourself and it costs less than $1,400, then that is still profit. That is still worth it. Here's another website. If we go on Tenants Cloud, I have not used this before. I will probably try it in the beginning of January, but I have not used it yet. I just want to give a forewarning. But this is $16.50 per month. And it has pretty much everything I would think the average landlord needs. So you can have an unlimited number of listings under any plan. And let's go through some of the features. So there's tenant screening, rental applications, online leases, even if you are handling roommates, maintenance requests, so those work orders I was talking about, rent reporting, maintenance bidding, so you can even get quotes. I'm kind of speculative on if this actually works or not. I still recommend my strategy above all. But you can collect online payments through it. It has a good accounting feature. You get the point here. And this is $16.50 a month and basically does what a property manager does. The only exception, I would say, for when a property manager is worth the money is if you are just extremely busy and you cannot even sacrifice 5 hours per month, so 1 hour a week in order to manage your property, and are okay getting 10% off of your ROI for that, then okay, whatever. I understand. Or the second option is, what do you do if you legally are not allowed to manage it out of state? So some states have a clause stating that if you are more than 50 miles away, if you don't live in the same state, etc., then you cannot manage it yourself. In those cases, you can get something called like name-only property managers. So they're property managers that are, I can't find any off the top of my head, but you will find some property managers, whether it be through those Facebook recommendations or the realtor, that charge super low fees. I'm talking like 4%. And in return, they basically only handle rent collection and late notices. And you can handle the rest. So yes, you're not at 0% and handling, all of it, but you at least still are saving a decent amount of money throughout this process, minimum 6%. And that's every single month. So in my opinion, still totally worth it. I will be talking more about how to do the showings, how to take good pictures, how to pick good tenants, etc. in part 5. But for now, let's move on. We're on to section 6, which are mistakes that will cost you thousands of dollars. So here are the most common mistakes that I just generally see on the market. And I'm reading off a list here. So using cheap flooring that peels in 6 months, or just cheap carpet, or installing carpet in general because carpet always gets trashed or destroyed or just covered in mud and pee, etc. Not testing all outlets and plumbing before the inspection. Forgetting to get permits that are required. For example, lead paint certification permits or rental city permits. Those are both typically required in most places. Hiring a property manager with absolutely zero experience, especially with Section 8 specifically. Not getting final walkthrough photos from your contractor that you hired, for example, a painter. paying for labor before materials and service are delivered. So what I'm kind of boiling down to is any way that you try to cheap out, you'll typically be dealing with much, much more headaches later down the line. And I'm not saying cheap out in like the sense of saving money. There's a difference between cheaping out and saving money. Those are very different things. Taking out your ceiling fan so it doesn't become an expense later down the line is saving money. Simply choosing to try to go through loopholes or, picking the cheapest carpet, that's just being cheap because it's going to hurt you in the long run. Section 7, how to prepare for tenant placement. And this is kind of circling back to the immediate after rehab steps, which is get the home deep cleaned. I highly recommend that. Either do it yourself or you can just hire cleaners. So typically, at least in my area, it'll be like a normal maid service will be around $300. If you do a full like in-depth move out clean, it's around $700, but those typically aren't needed unless a tenant has already lived there and like kind of dirtied up the place, right? If it already is in decent condition, which it should be considering you're buying mostly turnkey homes, then I don't think it's necessary. In fact, I think that if you went there yourself for 2 hours and a mop and a duster, it'd probably be fine. But either way, you do want it clean. Then, pass the section inspection, get photos taken, let your manager list it or list it yourself, and then submit the packet to Housing Authority. Now, here's the important part. Getting it approved changes heavily depending on the area you're in. So some places have very short processing times. Some places have extremely long processing times. It is up to you, the investor, to know this beforehand. And of course, if you are a student of mine, I help you get the Housing Authority numbers and call them in order to determine this for you. But if you're solo, then yes, you will genuinely need to call them and figure things out beforehand. For example, Cleveland, I believe that the latest Housing Authority, CMHA Housing Authority stated about a week ago, they told me that it takes about 2 to 3 months for them to process paperwork currently and get an inspector out there. That is quite a long time. And it'll cost you, if you're on average renting for $1,400, $2,800 in your gross income. Now, is that worth it? If home prices are 10K less than everywhere else, then okay, it might still be worth it. But that's my point. You want to know this beforehand and not make this a surprise. Okay, I think that is about everything for part 4. So you should know how to hire and manage contractors, what to rehab and what to skip, how to pass your section inspection, when to hire a property manager and how to find them, and what traps to avoid where new investors end up costing them a lot of money. If you have any questions, feel free to comment them down below. I'll do my best to answer them. I respond to most comments, and any link I mentioned will also be in the description below. As always, if you are interested in one-on-one mentorship where I personally help you avoid mistakes that are going to cost you $10,000, then click the first link in the description and book a free call with my team. And if you are interested in a free community of fellow investors doing the exact same thing you are, you can network with them. Or you can join my twice a week, Monday, Friday, Zoom calls, live Q&A sessions where you can ask me anything. Click the second link in the description and join that right now. I mean, it's free. Why not? Welcome to the final part of my Section 8 Mastery series. At this point, you've picked a city, secured financing, made the LLC, bought a property, rehabbed it, and now it is time to get the tenants in there as well as manage it for the long haul. This is probably the part that most people are scared of, which is the tenants. You can buy the perfect property in the perfect area and still lose money if you get a tenant who's going to rip out the copper wire and steal the fridge. So in this video, you're going to learn how to screen Section 8 tenants without breaking the law, how to get your unit enrolled and approved by the Housing Authority, how to create a smart lease, what maintenance systems to use to keep cash flow consistent, and how to avoid all of those new problems that landlords face. Section 1, the Section 8 enrollment process, how it works. Before you ever get a tenant actually inside of your home, you need to get approved by the local Housing Authority. So here is a step-by-step. Step 1. You list it on sites such as Zillow and affordablehousing.com, realtor.com, etc. And I make sure that I always buy the little boost that costs like $20 or $30 because it's pretty much guaranteed to get you a tenant. And I, of course, mentioned that on part 4 already, so I'll kind of skip over that. So once a Section 8 tenant applies to your property, they're going to tour it and say, hey, I have a 3-bedroom voucher. I love the property. Your house is 3 bedrooms. It matches up. I want to apply for this home. And if you agree, hey, I want you to be the tenant for this home, then they're going to hand you something called a voucher packet or a request for tenancy approval packet, something along those lines. The terms kind of change. So here is the request for tenancy approval. Of course, every single housing authority has a little bit different look to it, but this is the government HUD version where you're going to put down, public housing authority agency, the address, what the proposed rent is, security deposit, really just stuff that you as a landlord should already know. The unit's probably not subsidized. It's probably a single family detached. And this part is where you start putting in if you're paying for utilities. I pretty much always make the tenant pay them. Unless I can make a hybrid model, you'd have to call the housing authority and ask if they allow this because every single one is different. But I like the hybrid model of you as the landlord tell the housing authority, hey, I will keep all of the utilities in my own name as the landlord. In return, please send the utility voucher directly to me instead of the tenant. So that way it's guaranteed to come to you, instead of having to ask the tenant for it. And on top of that, say, also, I'm going to write into the lease that the remainder that isn't covered by the utility voucher is the tenant's responsibility. So for example, if the electricity voucher supplied by HUD is good for $100 and the total bill is $120 for the month, then you agree to pay $100 because that's what the voucher covers and the tenant has to cover $20. I like that model the best simply because it allows you, the landlord, to keep the utilities in your name to ensure there's no liens against the property if there's any unpaid bills. You're going to submit that packet I just showed you to the housing authority. They're going to review it, and then if they A-OK it, which they typically do, then they're going to schedule an inspection. I have gone over the inspections already in the last video. So if you pass the inspection, you're going to get a HAP contract signed, HAP, which stands for Housing Assistance Payment. The contract is going to be signed and then rent begins. So that is kind of the overview of how this process works. But how do you actually pick a good tenant? Well, here's section 2. So you listed it on Zillow, you listed it on affordable housing, you chose a decent rent already. How can you actually check for the tenants? Let's say that you listed it at 1,200. That is what's going on average in the area. The first week passes, you get 3 applications. Great. Here's what you can check. You can check prior landlord references. You can check eviction history, criminal background. You can check their credit. You can check whether they follow lease terms / cleanliness / property care. But you can't use their income level, right? Because the rent's covered by the government. You also can't really use any sources of income. For example, you can't say no just because they are a voucher holder or no because they aren't a voucher holder. You have to accept all applications coming in. Okay, but Joseph, all right, I understand that. How do you actually screen them? Well, you want to make sure you do not call the references they provide. You want to call up the actual property owner by reverse searching the address on the county website. So for example, if they live on 123 Main Street, you're not going to call Bob, who's listed as a reference, right? Because it could very well be a friend or family member. You want to Google 123 Main Street on the white pages and then find the actual property owner and call them directly. And just ask them, how many late payments have they had in the past 12 months? Have there been any lease violations in the past 12 months? Would you rent to them again? Now, you can ask that if it's a property manager, right? Because property managers don't care. They don't. And they also are licensed, so they're not going to lie to you. However, if you call them and it is an independent landlord, then you can't pose yourself as another landlord because they're going to say anything they can in order to make sure that they get the tenant out of there. If the tenant has 6 months of late payments, they're going to go, they're a perfect tenant. Jane Doe is amazing and you should definitely rent to them because they want them out of there. You want to approach as a neutral third party instead. I always like saying that I am an employer, potential employer. That typically helps. So that is one way, check all of the references. Of course, if they have a job, also call the job. You want to ask, how many times have they been late? How many no-shows have they done? Because that is also a good reflection of how responsible they are. Checking credit, I don't think matters that much because I mean, even regular tenants tend to have bad credit, let alone Section 8. But I do like to check their eviction history and criminal record. If there's any violent crime on their record, it is pretty much an instant rejection. If there is any eviction history within the past, 5 years, it's automatically a no as well. And the last step that I like to do is an at-home interview. And I know that this one is kind of controversial, but let me explain myself. So, what you can do, and I recommend doing this with full transparency. You're down to the final 3 applicants. Call each one up. Hey, I'm just picking between you and another person. Do you mind if I stop by your current place of residence and do an at-home interview? I think it'd really help. If they say no, red flag. That pretty much means that they don't want you to see their current place of living, right? Because it's probably trashed. If they say sure, then that's a good sign. So what do you look out for when you go out there in person? So, and by in person, I mean you can go out in person, or you can get your property manager to do it, or a handyman to do it. So when they go out there, or you go out there, you want to look at their car, right? If the car is old, if it's rusty, that's fine. My car was old and rusty. I had a 2005 Mitsubishi Galant, which I don't know if you guys have ever seen one before, but this is how my car looked. This was like literally the car that I had. In fact, it looked oddly similar to this one right here. Actually, it was pretty much this. This was my car. Yeah, you guys like that interior right there? That is exactly how it looked. My point is, car condition is not a good sign of whether someone is responsible or not. What is a good representation is how clean the car is. If the car is relatively clean, if there's not garbage stacked on the inside, then that's a good sign, because however they treat their car is how they treat your home. And you kind of check for the same thing inside of their house. If their house is, I assume, a rental, old and, it definitely is distressed. However, it's relatively clean. There's not holes in the drywall. There's not old Coca-Cola stains on the rugs. Then that's a great sign. That means they treat their current home decently. Maybe the landlord isn't upkeeping maintenance, but they at least do their part. So Section 3, what happens if you did your due diligence, right? But you still ended up picking the wrong tenant, or maybe just something happened. Let's say that they, had a medical emergency and they stopped paying rent, right? Something like that, or they couldn't clean anymore, or they got into an abusive relationship. Whatever the case is, good tenants can become bad tenants. It just happens sometimes. So this is the part that most people kind of gloss over or give too much leeway with until it's too late. Because even if Section 8 will pay the rent on time every single month, if a bad tenant destroys your house, then you're screwed come inspection time or when it's time for the next tenant. Because, if they damage the unit, you still have to pass the inspection before they renew. And if the unit fails the inspection, guess what? The housing authority stops payments until the fix is remedied. And if they damage the unit, you still have to evict them like any other tenant. Now, how do you avoid an eviction? Well, there is 2 main ways. Other than, of course, due diligence. Let's assume that this is past the due diligence part and they're already in your property. Well, number 1 is you do a warning. What you'll do is you'll get proof that they are breaking the lease, right? Whether it be an official noise complaint from the police, whether it be you drive by the property or someone drives by and you can clearly see 10 people living there, or it's something as simple as there is no $100 rent payment for the month. You're going to call the housing authority with whatever proof you have and just directly tell them that they will be evicted if they continue this behavior. So what the housing authority is going to do at that point is they're going to call the tenant and say, hey, John Doe, hey, Jane Doe, you guys are breaking the lease. We received proof of it. Your voucher will be revoked unless you can remedy the issue within 24 hours or 48 hours. And that pretty much jumpstarts them, right? They start getting sirens. They start getting sirens going off in their head saying, oh my God, I'm about to be evicted and they're going to revoke my voucher. Well, and that is terrible because these vouchers are tied to your social security number. If you're revoked from the voucher program, you can't get back in. There's no second chances. If you get kicked out, you're kicked out. You're done. So these tenants know that, if they're on average waiting for 2.5 years or 28 months just to even get a voucher, then of course they're not going to risk losing it just because of, noise complaints, etc. I mean, these vouchers are essentially a golden ticket from Willy Wonka for free rent for the rest of their lives. So yes, they will not do anything to jeopardize that. And if they do, right, let's say they continue getting noise complaints, just more lease violations happen, right? People are down on their luck. People are just bad people sometimes. Well, now you go on to the second strategy before I do an actual eviction. The second strategy, cash for keys. If you guys haven't heard of this, it is an agreement where a landlord pays a tenant a sum of money to vacate a property, often as an alternative to a traditional eviction. Now, what does this fully mean? Let me use an actual example. Jane and John Doe don't pay their rent, or they have noise complaints. The property manager or you go out to the property and you say, hey, I want to talk to you guys. Can I please speak with whoever the property decision maker and whoever pays the rent is? Can I speak with the head of the household? So Jane or John Doe comes out and you tell them, hey, I am the landlord, or I'm blank the representation for the landlord. You will be evicted at this rate. Section 8 has been warned. The housing authority has been warned, and I have clear proof that you are violating the lease. I will start an eviction by the end of the week. So how about this? I need to pay my mortgage or else I'm going to have to sell the house. You clearly need a place to live and don't have enough money. So how about this? I'm going to inspect the property today. I'm going to go in today, probably by the end of the day, and I'm going to do a full inspection, take pictures of everything. As long as no more damage is done to the property, and as long as you vacate within 5 days, I'm going to give you $500 in cash and your full security deposit back. They're usually going to honestly be a little bit upset. They're going to outburst a little bit and say, no, I deserve to be here, etc., etc. But then typically within a day or two, they're going to come to their senses, call back and say, hey, I'm willing to take the offer. In that case, they kind of know in their head, it's either this or I get kicked off of Section 8. Yes, if I end up saying, okay, do an eviction, maybe it'll take an extra 3 months, right? But I'll lose the voucher forever. And they typically can, view the pros and cons and think rationally after they've calmed down. Past that, unfortunately, it's an eviction. Just like any other tenant, evictions happen sometimes. It is what it is. You can't really avoid it. Moving on to Section 4, which is how do you structure the lease to be of the most benefit to you? And the housing authority might try to just give you a lease template, but you can use it, but still add these addendums to it. So the utility overage clause, which I mentioned earlier, if the tenant exceeds the utility allowance of, for example, $50 a month for water, then they pay the difference. Again, you're going to have to call the housing authority first to even see if this is allowable in your area. Some other key clauses are no smoking indoors, no vaping, anything like that, because it actually sticks into the walls and yellows them over time. So if a tenant stays for 5 years, then they're going to kind of look like the walls behind me if they were originally pure white. And also, it just really stinks. Like, it just smells bad. Like, I hate smoking. I don't want to be anywhere near smokers. They smell bad. The home smells bad, etc. Another addendum I like to have is that tenant has to pay any damages not caused by normal wear and tear. So what defines normal wear and tear? Normal wear and tear is basically degradation that happens just because a person is living there. So for example, after 5 to 10 years, the carpet starts to get dirty. That is an example of normal wear and tear. Another is that after 5 years, the fridge just happens to, go out on itself. Tenant didn't do anything bad. It's just at the end of its life. That is normal wear and tear that you, the landlord, would have to be responsible for. However, circumstances such as they break a window, that is not normal wear and tear. That is the tenant's responsibility. Another is that if they have a pit bull that ends up chewing up and tearing up the carpet, that is not normal wear and tear either. That is, again, up to the tenant to fix. So don't just say normal wear and tear, by the way. Don't just say tenant pays for all damages not caused by normal wear and tear. You want to be specific, right? Because the more specific you are, the harder it is for a judge to deny your claim. So you want to say, tenant is responsible for all window repairs. Tenant is responsible for upkeeping the lawn. Tenant is responsible for any damage done to the carpet that isn't general dirt, right? Tenant is responsible for removal of any stains in carpet caused by a liquid. You want to be very specific because if one of these clauses come up, well then you kind of have to deal with it in court, right? If you go to small claims court because you're saying, whoa, this carpet is destroyed, we can't, repair this, you're gonna have to pay for it, the tenant could easily go, oh man, well, you just bought cheap carpet originally, it's not my fault. Well, no. If you have pictures of it 6 months prior in perfect condition, you have an invoice for the work done to the carpet, and on top of that, you also wrote into the lease that the tenant is responsible for any damages to the carpet, then they're not going to have a case to support them. I also require every 6 months an inspection. So there are 3 inspections per year that end up happening. And I'll go over this a little bit more in the next section, but I like to just put in that landlord is allowed to do up to 4 inspections a year just to play it safe. You can also include an addendum that kind of has house rules, which I've already kind of mentioned. So you want to make sure that your lease has what the housing authority requires it to have, but then feel free to add your own stuff. I mean, realistically, if you're a good landlord, right, and most of them are fair clauses, then the tenant doesn't really have any way to argue. They can't say, oh, but if I break a window, that should be your responsibility. No, most of them are just going to silently read it, shut up, and sign. Now, again, you can't put stuff that is like very blatantly manipulative, right? Or slumlordy, right? I don't want to see any of you come to me and go, oh, I was charging $20 a month for ceiling fans. Like, no, you don't do that. Oh man, I was charging an additional $10 a month for a washing machine. Don't do that. No, that is slumlordy. And on top of that, it is also not allowed. You are not allowed to collect money on the side that isn't from the direct voucher and the utility voucher, of course. Moving on to section 5, which is maintenance. So how to stay profitable while also staying lean in costs. So here is a very simple system that I like to use for all of my tenants. Every 6 months, do a property walkthrough. So 6 months into the lease, you're going to want to look for leaks, look for pest issues, look for damage, cleanliness, etc. What you want to basically do is get the HQS inspection checklist that I mentioned prior, and you're going to do the exact same thing that you did prior to them moving in. So before you listed it for rent, you got this checklist, you went through it all, you made sure that your empty vacant property had all of these fine so that you passed the inspection on the first go. You're going to do the exact same thing. The only difference is now you might have to walk around a load of laundry. You're going to take this inspection checklist or your property manager / handyman. You're going to go out to the property and then you're just going to do a regular HQS inspection, but you're going to do it by yourself. Do that at the 6 month marker. And then I do a second one 2 weeks before the actual inspection from Section 8. The reason I say 2 weeks is because if there is a decently large problem, for example, a pretty large burst pipe or the water heater isn't working, then you have 2 weeks to fix it. And typically that is how long most contractors need to fix major problems. Again, you don't want to do crazy stuff that isn't needed to pass the inspection, right? You don't want to install new ceiling fans, right? Because you want to be nice. You don't have to install a dishwasher because they asked. No, do what's needed to pass the inspection. And as a little bonus on top, I like to tell the tenants that if they pass the property inspection from Section 8 on the first go, then that gets them 10% off their portion of the rent for the month. Now, I'm not saying total rent. If the rent's $1,400, I'm not saying $140 off. I'm saying if the rent's $1,400 and they have to pay $300 of that, then they're getting 10% off of $300 or $30. So what is effectively 2 meals for them, right? Now you might be thinking, oh, that's really like scummy. That's almost nothing. I don't have to do this. This is a bonus for them. I don't have to do anything, right? But on top of that, $30 is still a decent amount of money to a lot of people, right? Maybe you might have a little bit of skewed perspective because you're buying a house and need $25,000 for it. But if you are only making, $800 a month, $700 a month, maybe even disabled or elderly, then that $30 for a nice meal goes a long way. I also like to, and this is kind of controversial, I like to never touch the money. I don't touch any of the profit from every property at all. The only 2 times I'll ever touch the money is A, if a repair needs to be done, or B, if I am going to use the collective money for another down payment. Other than that, it's never touched. I don't use it for my own spending. I don't bring it to my own checking account at all. It is independent because I am extremely conservative with the amount of risk I take on. So let's say that there is a pretty decent roof repair that needs to happen that costs, 5,000. Well, then guess what? I have 10 grand sitting in that account just because I haven't collected any of the rent into my own account in the last year. And yes, that is crazy conservative. And yes, that kind of goes against a lot of what some of your goals are, which is financial freedom. But I make enough money otherwise, right? And I'm completely fine with letting the money sit there in case of emergencies. Or let's say I have 3 homes and there's 10K in each account. Well, I'm going to take 25K total from the 3 accounts and put it towards another down payment instead. And then rinse and repeat, let everything build again. You also want to make sure, and I kind of said this prior in a different part, that you want to have a trusted management team. And not management in the sense of that they're going to collect rent, but management in that you have your maintenance guys, you have your handyman, you have your plumbers, you have your electricians. You know who to call if a problem comes up. You should already know a few of them, at least, just going throughout this process. For example, if your home inspection revealed roofing issues, then you probably found a roofer at that time. And if not, then you want to just have a full list of pretty much every type of contractor you'll need. You want to have handyman, plumbers, electricians, roofers. You want to have a foundation guy. You want to have a water removal guy, in case a pipe bursts while the property is empty. You want to have insurance brokers. And I think that's all you typically need. Oh, and a pest control guy. Now, again, how do you actually handle these requests for work done? How do you manage it? Well, there's a few choices. You can either do property management, typically taking 10% of the rent, or you can use software. So I've shown this in a previous part, so I'm only going to touch on it. But RentSpree is fantastic for screening tenants, and you can even collect rent from it, but I don't use it for that purpose. I use it just for screening tenants. If you want to collect rent, you can go to Zillow's Rental Manager, which I don't know how this thing's free, but you can... Last I checked, this function didn't work, the create and send leases. This didn't work last time I set this up about a year ago for one of my tenants. But before that, we currently use it for collecting rent online. So it is completely for free. And if the tenant pays using ACH, then it's free for them as well. So I don't know how this isn't paid. Don't know how that works, but it is completely free. But how do you actually manage it? Well, if you just Google property management software, there's a lot out there. A lot of people like Appfolio. However, Appfolio is only if you have quite a large number of properties. So for example, if you go to the pricing tab, I believe you need, at least 50 units in order to use Appfolio. So obviously, most of you watching are under 50 units, in which case I like Tenant Cloud. Again, I haven't actually used this yet. I want to be very clear about that. I'm going to start using it probably at the beginning of the year, but it is $16.50. You can have unlimited amount of properties, and it has a lot of features. I don't know how much is included in just this starter plan. However, it looks like you can at least collect rent. You can at least manage maintenance. So I'm guessing they can submit work orders. And you can handle applications. So it kind of sounds like it has everything you need. However, it does have a cost of $16.50 a month. Are there any other softwares? What's Buildium? I haven't looked at this one. Let's look together. Oh man, this almost has the exact same layout as Tenant Cloud. That's kind of funny. What's the pricing for this one? $60 a month. What does it include? How do they do property inspections if this is an online software? What does that mean? I don't know what property inspections mean. I don't know if they have people in like every single city, or if they're just saying they have like a template for you to do them. I don't know what that means fully, but it looks like they have basic accounting, work orders, violations, a communication board, online portal. Those are all pretty normal. Tenant screening, $5 per e-signature. Okay, and it looks like they do have a $2 transaction fee. So this one does look a little bit more expensive than Tenant Cloud. What about Rent Ready? How's this one? $30 a month. Okay, that's pretty good. And in return, you get all of this. So I'm not going to keep looking. Long story short is the software exists. Now, moving on to the last section, section 6. Should you keep managing it yourself or hand it off? I always say that if you're local, manage it yourself. That's a no-brainer. If you are local, don't even think about getting a property manager because it's kind of a waste unless you are like working 100 hours a week or something. Just manage it yourself. It's not that hard, especially if you're local. But once you scale or you're fully out of state, then you might need property management. So I mentioned this in a previous part. So I'll, again, only briefly go over this, but a good property manager handles annual inspections, maintenance calls, rent collection, posting notices, evictions, and paperwork with the housing authority. Now, if you didn't notice, most of those are one-time issues that really only happen when a tenant moves in or out. If the average tenant stays for 6 years, you don't have to do that often. You might be thinking, who would ever use property management then, if I can just do it myself? Well, there might be specific cases. So, for example, here is an example of a specific scenario. There is something called the VRLTA, which basically states that it states pretty much all of the landlord-tenant laws. And one of them is, where is it? Here it is. So 55.1-1211. So appointment of resident agent by non-resident property owner. This basically states that if you don't live in Virginia, you have to appoint an agent who is responsible for maintaining a business office within the Commonwealth, and that this agent has to be the one who is contacted if the tenant ever has any issues. So all you really need, in Virginia at least, is someone who can collect documents and be the point of contact, basically. Every single place is different, so I highly recommend simply just Googling it and determining whether you actually need property management. If you're out of state, for example, if I'm investing in Ohio, do I actually need property management legally, or do I just need a registered agent to appoint? And if it does require property management, well, there is also a way around that. There are these property managers that exist that really only collect the rent. Might hand out a late notice here and there, but they don't really do much. They just collect the rent. They typically charge a way lower amount too, typically 4%, meaning you could still save throughout this process between 6 to 8% if you hire the 4% guy and then do the rest yourself. All right, and the last part, I know I said it was done, but there's one more part, which is scaling. After a year passes, you can ask for a rent increase by the housing authority. So to get approved, you have to provide market rent justification, for example, comps from Zillow or affordable housing. You also have to keep the unit in good condition and request in writing 60 days prior to the lease renewal. Now, what happens if they reject it? Well, you can negotiate. Everything's negotiable in life. You can ask them, okay, what about instead of a 5% increase, a 3%? And typically I see that they're much harder to approve past 3 to 3.5% increases. But if it's under that and you have good justification, then it's a lot easier to get it approved. And don't be like a meanie about this. Don't be rude to the housing authority employees. Like, from my experience, housing authority employees definitely are kind of rude and kind of mean. So if you are the person that shows up with a box of donuts, or you're the person that, compliments their outfit for the day, then it goes a long way. It really does. Wow, who knew being nice helped? Crazy, right? So as I mentioned prior, never touch the money. You're going to instead, in what I like to do is take that money and keep it in the business account, never touch it, and then use your money from your W-2 job or other investments, pool it together, and whenever you're ready for the next house, then buy. And you can just rinse and repeat over and over and over and over again. I see most investors start off with one house a year, and then on the third or fourth year, they're doing 2 houses a year. And then they tend to do 2 houses a year until they're about at 10. And when you're at 10 homes, you're typically making $5,000 net per month. And most people stop there because they just retire, or you can keep going and start doing 3 per year instead. So that is everything. I've made it through all 5 parts, whether you're watching this independently on part 5 or in the final huge compilation video. I'm finished. My throat hurts. Now I can give my little, I feel like I'm allowed to shell myself out now because I have probably just finished making the longest and most thorough Section 8 tutorial out there that exists. So by now, you should know from beginning to end the exact process. And of course, if you want screening templates, if you want lease clause examples, you want my inspection checklist, you want my guidance, really, my mentorship, my handholding, go ahead and click the first link in the description because I have a link to my mentorship program. It is purely one-on-one. It's not just a PowerPoint. And go ahead and book a free call with my team to see if it's right for you. And if you click the second link in the description, it is actually a link to a free school community. It is completely for free. That's not a joke. You can talk with fellow investors about Section 8, network with them. And on top of that, I also have a twice a week, Monday, Friday group call that I do where anyone can ask me anything completely live. As always, I am Joseph Khateri. Comment down below any questions you have and have a nice day.